I'm Shauna Smith alongside Madison Mills, and this is Yahoo Finance's flagship show, The Morning Brief.
Stock futures are edging higher, offering some relief from last week's volatility as investors look ahead to key data prints. Key inflation data and retail sales could offer investors more clarity on the health of the economy. We'll bring you insights on how to navigate the market reaction to that data. Let's get to it with the three things you need to know to start your trading day. Yahoo Finance's Jared Blickery, Josh Schaefer, and Rick Newman have more.
That's right. Stock futures are higher this morning after a roller coaster of a week. On Friday, all three major averages closed higher on the day, but in the red for the week. The S&P 500 and the Nasdaq Composite are down 4 straight weeks now. The S&P 500's longest losing streak since September. Some big tech names, Amazon, Alphabet, Microsoft, and Tesla, have closed lower 5 weeks in a row. Stocks looking to snap these negative streaks this week as Wall Street looks to fresh economic data. We're going to get PPI, CPI, and retail sales, along with a number of consumer-centric earnings.
And Bank of America CEO Brian Moynihan is urging the Fed to cut interest rates to ease the pressure on a slowing consumer. In an interview with CBS's Face the Nation on Sunday, Moynihan said the Fed needs to be careful and start to talk rate cuts or risk dispiriting the American consumer. Around half of traders are pricing in a 50% basis point cut in September. That's according to the CME Fed Watch tool, which tracks target rate probabilities.
And Vice President Kamala Harris is vowing to support an independent Federal Reserve, telling reporters on Saturday she would never interfere in the decisions of the central bank. Her comments contrast with those of former President Donald Trump, who said last week that the president should have a say in Fed policy. Trump appointed Fed Chair Powell back in 2017, but he's been a vocal critic for years, recently saying Powell has been a little too early and a little too late in terms of adjusting interest rates. However, Trump did say in a Bloomberg interview last month that he would not fire Powell, but would let him serve out his term.
Our top story this morning, stock futures edging higher here as Wall Street anticipating a new slew of data that will clarify the health of the economy. This week is especially critical after that weaker than expected jobs data whipsawed stocks, leading the S&P to both its best and worst days of the year last week. Now for this week, we've got on tap inflation, retail sales, and retail earnings. We also have the producer price index out Tuesday, but the big focus is that consumer price index print. Headline inflation expected to grow 0.2% from the prior month. And last month's CPI print, you can see here that year-over-year number coming in at 3%. Moving forward here, that is going to be a key thing to watch, that 3% annual inflation number. Investors do anticipate a decline in the Fed's preferred inflation metric to come this week.
The second thing to watch is retail sales. And the big concern here for investors has been about growth. So some are actually arguing that this print is just as important for the market as the inflation prints that we're getting here this week. Expectations are for sales to rise 0.4%. That would be versus the flat reading that we got back in June. So a bit of an improvement is what is expected right now. Investors are going to be closely watching this report and those two inflation prints to get a better idea on the timing and also potentially the likely size of the rate cut that we could be hearing from the Fed in September.
And the third thing we're watching is those retail earnings. We'll get results from big box retailers, Home Depot, that's coming up on Tuesday, and then Walmart out on Thursday. Both will provide further commentary on the consumer and whether we're seeing any kind of slowdown more broadly.
Let's kick it off with the markets because those key inflation data prints that are going to be out this week are going to give us a little bit more insight maybe onto the Fed's next moves on rates. Bank of America CEO Brian Moynihan urging the Fed to cut rates in September. In an interview over the weekend, he said, quote, "It's time for the Fed to take the restrictions off." Joining us now to discuss what's next, we want to bring in Kenny Polcari. He is Case Capital Advisors managing partner. Kenny, it's great to see you. So let's just first take a step back. Coming off what was last week, a very, very tumultuous week here for the markets. We're setting up for what could be another volatile week here for stocks. What should investors be doing or anticipating here ahead of those key econ prints that we will be getting?
Well, a couple of things, right? Good morning. Nice to have you. Nice to be with you. A couple of things, right? Last week was a very, very volatile week. On Monday, there was a lot of internal damage done to the market. So investors need to understand that it's going to remain volatile, and we're probably going to have to retest those lows over some period between probably now and the end of the month. Tomorrow's PPI and Wednesday's CPI are going to be key factors in inflation. They are supposed to come in a little bit better than the expectation. So that's going to help the argument that the Fed needs to start cutting rates. Does the Fed need to start cutting them drastically by a half a basis point or 3/4 of a basis point? I don't think so. I think a 25 basis point move is really what the market is expecting. I think that's what a lot of economists are expecting, but I think street analysts are expecting for a bigger move, which I think would be a mistake. So I think investors need to understand the data that's coming. They also need to understand August is kind of a funny month, right? There's a lot of people on vacation, so there's a lot less volumes. And so moves can be exaggerated in either direction based on the data that comes out. So don't put too much thought into it as you have to kind of watch as the market reacts to the data without getting too impatient, right? Patience at this time is very much a virtue.
Kenny, do you think there's a chance that we are overpricing the likelihood of a huge market reaction to this data print, given that the market has particularly been concerned about the labor market so far versus the inflation data? And the real question has been about a growth scare, not about an inflationary scare.
I think the market is now very sensitive, is overreacting to both, to all the economic data that comes out, right? If the CPI number is better than expected, I would expect another overreaction, demanding that the Fed needs to cut rates. They need to cut it sooner rather than later. They need to make a bigger cut. I think the Fed is actually doing the right thing, especially after last week's Monday move and the calls for an emergency rate cut meeting. And oh my God, the world was coming to an end. In fact, they sat back and they said, slow down. We're watching it. We understand we have it under control. And look, the market kind of rebalanced, did not completely, which is why I think they're still concerned. But I think you have to be careful, especially in August, that the market overreacts either way to the expectation. Although I do think that there is some reality to a slowing growth story, not necessarily a crash, but certainly a slowing growth story, and that's okay considering from where we came.
Well, so again, Kenny, what do you make of the comments from Bank of America CEO Brian Moynihan really pushing for a September cut? If we don't get a cut in September, there's lots of talk about 50 basis points, but what if we don't even get 25? Would that be a mistake?
I think we are getting a cut in September. I think we're going to get 25 basis points. I think actually a 50 basis point would be the mistake. I don't think at this point.
Why, Kenny?
As long as the data continues to be what it is and the CPI and PPI continue to be better, I don't see how the Fed cannot cut. They've prepared the markets for a cut. They've been talking about it. They didn't prepare the markets for a July cut, and so we didn't get one. But they are preparing it for a September cut, and I think 25 basis points is right, and I think Moynihan is correct.
But Kenny, why would 50 be wrong? Is it just because that risk that you still see here to the upside for inflation?
No, I think 50 would be wrong because 50 in my mind would suggest that, that the Fed is behind the 8 ball and now they're trying to play catch up because they see something more negative on the horizon. So I think 50 basis points just gives the impression that we missed it. We're trying to catch up, and that would create some concern. I think if they stick to 25, that's what they've been saying all along. I think that would help the market smooth out.
Kenny, I want to shift gears a little bit and talk about the election. In the notes that you sent over to us, you had a quote saying the Biden-Harris years have been a, quote, disaster for the economy. Talk to me about where you stand in your thinking on what either candidate's potential in the White House come November could mean for the economic path here moving forward.
Well, it's very interesting. We kind of know where Trump stands in terms of the economy and policies that he'd like to implement. We still have not heard from the other side. We have not heard from Kamala Harris's campaign on what her policies are. She's out there waving everybody saying, I'm going to change things and I'm going to do this and I'm going to do that. But there's no policy. You go to her website, there's no policy. So we still don't know what Kamala Harris and that ticket is really planning in terms of policies. We do have a sense with Trump. We understand where he wants to go. He's been very clear. We have a history with that. We don't have one with Kamala Harris at all, and she's not really putting one forth, at least not yet. And that's causing more uncertainty and lack of clarity in the markets. At some point, she's going to have to stand up and say, look, this is the policy. This is the platform. Maybe we're going to get it this week at the Democratic National Convention. Maybe. And if we do, then it'll be clearer for investors to kind of assess, okay, here's what he thinks, here's what she thinks, and where are we, right? Where are we as investors in terms of where do we think it should go?
So, Kenny, what should investors then be doing when they're trying to position their portfolio? There's a slew of uncertainty out there. Should they be making any changes now, and why or why not?
So I think as a long-term investor, here's what you have to do. You have to, at this time, I think if you're going to add more money to your portfolio, you have to add it defensively. So you have to think of kind of big, boring names, consumer staple names. You got to think of utilities, which are the most boring sector in the whole group. But at this time, especially if rates are going to go lower, utilities will benefit, right? NEE is a great name. That's still down 12% from when they started raising rates 2 years ago. So if they start cutting rates, NEE is going to be one of those names that benefits from that. And it already is in anticipation, right? Consumer staples are another kind of boring group, yet they're good dividend payers. And look, there's stuff that we need. Procter & Gamble, Kimberly-Clark, Johnson & Johnson. Those are all things, whether we're in a recession or not, that consumers are going to need. So you got to get a little bit more defensive. Now, if we see a big pullback in some significant names, whether they're tech or otherwise, NVIDIA was off 30% by Wednesday night. Now, it rallied a little bit on Thursday and Friday, but it was off 30%. That was a screaming buy for me. Whether or not you like tech or not, or you think, you shouldn't be in tech because it's too nervous, down 30% in NVIDIA when the story hasn't changed was a real opportunity for the long-term investor that's looking out 5, 10, 15 years, right? And so that's how you have to position yourself. But if you're really nervous about what's going to happen over the next 2 or 3 months, which is a seasonally weak time of year in the markets anyway, August to October is seasonally weak. The market tends to go lower. Then either you do two things: you get more defensive with the boring names, consumer staples, utilities, or you put your money in treasuries, earning 5% or 4.5%. That is also an investment decision.
Right. That's certainly some activity that we are starting to see, Kenny. Thank you so much for joining us. That was Kenny Polcari, Case Capital Advisors Managing Partner. Thanks so much.
Bye-bye.
Turning now to that November election, Vice President Kamala Harris drawing a stark difference between herself and former President Donald Trump regarding potential central bank policy, calling the Fed an independent entity and saying she will not interfere with its decision-making. This comes after Trump said the president should have a say in Fed policy. Here with reaction, we've got Yahoo Finance's senior columnist, Rick Newman. So Rick, it's interesting. I was hearing a lot of commentary over the weekend about the initial Wall Street Journal report. They had access to a 10-page note that they say indicated former President Trump's thinking on potential central bank policy moving forward. And there's a lot of commentary about how that memo should be released by the Journal. What are you hearing in terms of reaction to the difference in central bank policy from both candidates?
I think this is just confirming what we already know. Trump, when he was president, he complained about the Fed all the time when it wasn't doing what he wanted. And what he generally wants is the Fed always to be lowering interest rates and have the lowest possible interest rates. Remember, he used to be a developer, and developers borrow a lot of money. So that's his bias. He said last week at the press conference, where the news conference with no news, he said, yes, he thinks the president should have some say in what the Federal Reserve does. And the default position of almost every other president, going back to Jimmy Carter, Nixon is an exception here, is no, you stay out of the Fed's business. Let the Fed do what it needs to do, because we've got political interference every place else in Washington. So let's at least let this one institution, which is the most important financial institution in the world, let's at least let this institution operate without political interference. That's the default position. Trump is the outlier here. So no surprise at all that Kamala Harris would say, I'm not like Trump. I won't mess with the Federal Reserve.
All right, Rick, sorry about that. We're going to continue to watch, and we'll catch up with you next hour from the latest developments out of D.C. Rick Newman, thanks so much.
See ya.
Let's take a look at the crypto market, because Bitcoin prices falling further here this morning, extending the sell-off that we saw over the weekend. It's now trading just below that $60,000 level. Jared Blickery standing by with a closer look at this move here to the downside. Jared.
Yeah, 60,000 is kind of my line in the sand, but it keeps going above and below, and it's been in flux for a little bit here, a real level in play. And the reason is it just kind of sticks out on some of these charts. Now, the interesting thing about Bitcoin is it has been breaching the 60,000 level. It first did that in May, then in July, and more recently in August. It's been breaching it and hitting it more farther and farther down to the downside. But as I've also been pointing out on a 5-year chart, this is simply a bull flag. So above 60,000, I tend to be bullish, and below, I tend to be bearish. We'll have to see what that next catalyst is. I want to talk about ETF flows real quickly, and that's because even though we saw some flows out of ETFs last Friday, I was tracking the Thursday to Thursday flows, And despite all of this pressure, all the selling and all the volatility that we've seen over the last month, we're still seeing inflows into the ETFs. And I think that's a positive story. You take out those two grayscale ETFs, so spot Bitcoin and spot Ether ETFs that have higher fees, we actually had additions of about $250 to $300 million in those ETFs from Thursday to Thursday. So on that front, it looks like the new people who are investing in these ETFs, for lack of a better term, they have diamond hands. Also want to consider that the dollar is up today. So we're seeing not only Bitcoin, a little bit of a weakness in Bitcoin, but we're seeing some strength in the dollar. And interestingly, we're also seeing record highs in gold. So maybe something's underfoot there, something we'll be tracking in the hours and days to come. Guys?
We certainly will be. All right, Jared, thanks so much for kicking us off here this morning. Coming up, we're taking a look at NVIDIA. Shares are trying to regain its footing. Looks like we're looking at a move to the upside here ahead of the open, up just about 1.5%. Coming up, we will discuss with an analyst the best ways to play the chip sector next.
Chip stocks are looking to regain footing after a volatile week for markets. Semiconductor ETFs in particular bearing a bit of the brunt of the market rout last week. But let's focus on the chip giant NVIDIA, losing over $900 billion in market cap since its prior highs back in June. It did recover towards the end of the week and does continue to rise as investors anticipate earnings coming up in a few weeks here. So joining us to discuss what is next in the chip space, we've got John Vinh. He is KeyBank's Capital Markets Equity Research Analyst. John, it's great great to speak with you. So obviously the volatility impacted the entire market, and chip stocks, of course, were a part of that. What do you think will be the single biggest driver of chip stocks moving forward in the next couple of weeks as we do wait for those NVIDIA earnings?
Yeah, I think you're going to have maybe a couple earnings reports before NVIDIA. You've got ADI reporting next week, which obviously is going to be a read on the broader recovery from a cyclical perspective. But I think outside of that, I think all eyes are going to be focused on NVIDIA's earnings in 2 weeks.
John, what do you think we're going to hear from NVIDIA? Because we talk about the lack of catalyst between now and then. Do you think they're going to meet and exceed expectations, which is ultimately the huge question right now?
Yes, we do. I think if you look at the sell-off over the last several weeks related to the chip sector, and maybe more specifically to NVIDIA, I think one, you have some concerns about maybe hyperscale CapEx getting to kind of peak levels, but I think those were largely addressed later when you had comments coming out from Microsoft that it's still seeing phenomenal demand on the AI front, and it's actually supply constrained. And then obviously the second factor is, there's some concerns out there that its next generation Blackwell product could be delayed. I wouldn't find that too surprising. They're on an annual chip cadence, which is something that's really never been done before within the AI industry. Typically, you're on a 2 to 3 year cadence. So if you're kind of moving to an annual cadence, I don't think that's surprising. And I think investors, if it's really a supply or timing issues, I think most investors are willing to kind of look through that. If it was a demand issue, I think we'd have other issues here with NVIDIA. But from our perspective, we think they'll beat and raise. We don't think near-term demand is going to be an issue at all.
What do you anticipate the market reaction to that looking like? Because we have seen NVIDIA come out in the past and beat and raise, and the market has not necessarily rallied around that news because the anticipation is so baked in.
I would say with a pullback in the stock to around $100, I think a beat and a raise, assuming that it's pretty solid, should be adequate. If you think about NVIDIA's valuation at these levels, we think they're going to do, over $5 and change next year. You're trading at 20 times, which is, puts NVIDIA almost into kind of value stock range relative to the broader semiconductor market, which is kind of trading at kind of mid to high 20s right now.
So, John, there's lots to like, it sounds like, about NVIDIA. What would you tell investors is the most compelling second source play on AI?
We like monolithic power. They're a derivative play on NVIDIA. They supply power management solutions to the majority of NVIDIA's GPU solutions. In the next generation Blackwell, they're also going to gain significant amounts of content. Their ASPs are going to go up 40%. And then they're also gaining share at other providers. They're also now supplying power to AMD's GPUs. And later this year, we think they're also going to gain share on Google's TPUs.
What do you look at to indicate that thesis, John? Because, and I asked because I was going to ask you about your call on Micron. You did trim your price target, and you noted a couple of reasons why, particularly given the demand for the data center piece there. But what is the one thing that investors should take a look at when they are determining the long-term potential gains of an AI play?
Yeah, I would say kind of barriers to entry. I think when you think about NVIDIA, it's obviously got a significant advantage from a software mode perspective with CUDA, and also just their competitiveness. If you look at their next generation Blackwell solution, particularly GB200, this is not an incremental performance improvement that you typically get when a semiconductor company releases their next generation chip. This is a pretty transformational release where they're moving from a chip-based solution to a full stack server rack solutions where there's going to be potentially a 20 to 30x performance improvement. So I think that's kind of what you're going to be focusing on when you look at AI plays is, will they be able to continue to kind of push the envelope in terms of improving their performance leadership?
So then, John, where does that leave some of those other secondary plays when you take a look at AMD, some stocks that have been on a volatile run here over the last several months? Some of that negative moves that we had been seeing leading up to the last couple of weeks to the downside, was that a bit overdone? And do you see significant room to the upside?
I do. I think we still like AMD quite a bit. I think when NVIDIA first released their GB200 platform, I think there were some concerns out there of whether anyone else in the marketplace can compete and keep up with NVIDIA. I would say a couple of things, right? Obviously, the potential delay with Blackwell potentially gives AMD a little bit more breathing room. And in the history of technology, we have never seen somebody have a kind of a monopolistic position. It's just not sustainable. The market forces will not allow it. We think AMD has a competitive solution in MI300X. We think they're going to do $6 billion in revenues this year, which is obviously very small compared to what NVIDIA is going to do, but it's notable.
All right, John Vinh, great to get your insight here. Thanks so much for breaking down some of the recent moves that we've been seeing within the chip space. Equity research analyst at KeyBanc Capital Markets. Thanks so much.
Thank you.
Well, Disney villains are getting a new home. Disney giving fans a glimpse into the next few years with some big announcements, including a slew of theme park expansions headlined by the Land for Villains, which is going to be inside Magic Kingdom. Yahoo Finance's Alexandra Canal has the details. And Ali, the big reason that we're covering this is because of the slowdown or maybe some of the weakness that we are starting to see within the parks business.
Yeah, absolutely. And that is something that we saw in the latest earnings report, which I will get to in a bit. But you mentioned the Land of Villains. And this is something that stood out to me. I mean, some Cruella de Vil hangs at the Magic Kingdom. I'm certainly down for that. But it wasn't the only announcement out of D23, which is the expo Disney hosts every 2 years or so that gives fans a taste of what's to come. Outside of the Land of Villains, the Cars franchise will also be heading to the Magic Kingdom, along with Encanto and Indiana Jones. Now, some of these projects are slated for a debut by 2027. For others, still a TBD, but Disney said it will be part of the largest ever expansion of the Magic Kingdom. Meanwhile, over at Hollywood Studios, we'll have Monsters Inc. Land joining the lands of Toy Story and Star Wars, while more Avengers and Avatar attractions are set to come to California's Disneyland parks. Now remember, Disney previously announced plans to invest $60 billion into its theme park business over the next 10 years, but investors have remained cautious, as you said, Shauna, that park demand slowing. In that earnings report that we got last week, Disney reported a 6% year-over-year decline in domestic operating income. The company also warned that demand moderation, it could continue over the next few quarters. That led to a drop in Disney's share price as the weakness in parks dented an otherwise positive report there. So Disney certainly hoping that these new attractions and parks can reinvigorate some of that demand. But as the U.S. economy slows, so does that discretionary income. So it could be a bumpy few quarters ahead for this company. Despite all of the announcements, Disney shares this morning are trading roughly flat. All right, Ali, thank you so much for joining us on that. Really do appreciate it, as always. Taking a look at another stock, we are looking at shares of Starbucks are moving to the upside. This comes after the Wall Street Journal reported activist investor Starboard Value has taken a stake in the company. Sales in Starbucks' key U.S. and China markets have plummeted, prompting the chain to cut its financial guidance twice this year. The stock is down around 20% so far this year. You can see it recovering up about 1.5%, continuing those gains in the pre-market here just a few minutes prior to the open. But I do want to call out some reporting that we are getting in from CNBC about a previous stake from Elliott in Starbucks. This reporting from CNBC's David Faber saying that Starbucks and activist investor Elliott are discussing a possible settlement, and that could include Jesse Cohn joining the Starbucks board. Any deal, though, is not certain, but that could also be why we are seeing a little bit of a paring back potentially of the market gains, but interesting to monitor both of these kind of stakes in Starbucks given the volatility that Starbucks has had over the past year or so.
Yeah, it's been an underperformer. The stock off more than 20% year to date. So there has been a lot of pressure, even just amongst investors trying to push for some changes. In that last earnings report that we got from the Starbucks, their CEO saying that, quote, our conversations to date have been constructive. He was talking about those conversations with Elliott, and that is when they did confirm that Elliott had acquired a stake within the company. So now we have reports of Starboard taking the stake in Starbucks, and clearly not the first time that we're seeing some of these changes that have been that activist investors are trying to push. So of course the question is what exactly those changes look like going forward, what exactly Starboard would like to see in terms of those changes at Starbucks. And remember that this comes at a time when Starbucks has been very challenged. Taking a look at their latest earnings report, you can see the decline in earnings and revenue for the first 3 quarters. You can also go on to say that they did note the cautious consumer environment, that was impacting results. International sales, China in particular, were also experiencing some weakness. So again, at least it looks like when you take a look at Friday's move to the upside after the bell, when you also take a look at some of the movement that we're seeing here this morning, ahead of the opening bell, investors may be a bit encouraged by some of the changes that could take place as a result of this push here from activist investors. But again, the latest report coming out of CNBC saying that they may have reached a deal with Elliott Management. So of course, we will continue to track that. Let's take a look at the opening bell on Wall Street as we kick off a new trading week, coming off the heels of what was a very volatile week for the markets last week. Just 7 days ago, we were looking at a totally different story when we had that meltdown in the markets triggered by some weakness from the jobs report, also the yen carry trade, a rollover there. That spooked some weakness market-wide. Now here we are a week later, and it seems like a sense of calmness has returned. But of course, Maddie, the question is whether or not that is going to continue to be the case as we look ahead to some key econ data prints later this week.
That's exactly right, Shauna, and that's what we've been really asking our guests this morning is what is the market reaction going to look like when we do get that key inflation data and, of course, retail sales data as well. But let's get to Yahoo Finance's Jared Blickery for a look at what is going on the market side ahead of that data. Jared, what do you got?
Yes, we're looking at bullish action on the left side of the board here. You can see there was a little bit of weakness in the middle. Paris down about 20 basis points and mixed board over in Asia. But let's focus on what's happening in the U.S. Stocks are coming off 4 weeks of losses, but S&P 500 staged a monstrous comeback. Let's just show a 10-day chart here. I'll put some lines on it so you can see it a little bit better. And here was that big drop that we saw late last week into early, or the week before that actually, into early last week. And this is we've seen a huge shift in sentiment over the last few weeks in both directions. Here's a tweet that comes from Charlie Belayo. The percent of bulls in the Investors Intelligence Sentiment Index moved down over 17% in the past 2 weeks. That's the biggest 2-week drop in percentage terms since the October 1987 crash. So just big swings in both directions, and I think that kind of encapsulates where we are. We're also seeing this incredible return to low VIX readings. Remember, last Monday, we were all the way at 65. That is just eye-watering. That's something that happens in the middle of bear markets, at the lows, not in the middle of bull markets. But we're right back to 20 and a half, just like everything's normal. To say, though, that we were actually at 13, 14, sometimes 12 in the weeks before. So we're not quite back at those levels. Here's a 10-year T-note yield down, up about 2 basis points today. But I do want to get to some of our heat maps and see what's going on in sector land. We got energy. WTI crude up about 1.5%, so energy is our leading sector of the day. Close on its heels, actually just took the #1 spot. That would be XLK, that is tech. Financials also outperforming to the downside. We got real estate, healthcare, discretionary utilities, and staples, all slightly in the red. Guys?
All right, Jared, thanks so much for bringing us those market moves. As always, we do appreciate it. Coming up, Wall Street still on edge after a week of big swings and volatility. We're going to have expert analysis on why the week ahead is crucial for markets. That's next.
Stock futures are relatively quiet this morning after a whipsaw week left investors on edge. We're looking at a mixed picture right now with the Nasdaq leading the way, up just about 0.4%. Well, now Wall Street is bracing for a fresh read on inflation and also retail sales. That is going to provide some insight as to whether or not maybe a U.S. recession could be in the cards, a fear that had embroiled markets last week. For more, we want to bring in Marianne Bartels, as she is the chief investment strategist at Sanctuary Wealth, and we also have Dennis DeBuscher. He is the president of 22V Research. It's great to have both of you. Marianne, let me start with you. Coming off of what was obviously a very volatile week here for the markets this week, what do you think the setup looks like ahead of those econ prints that we're going to be getting later this week?
Because of the violent move that we had from the deleveraging of the yen carry trade and the major spike that we had in the VIX, which was the third highest going all the way back to 2008 and 2009, we now have very oversold conditions within the marketplace, whether you're looking at the S&P, Nasdaq, Magnificent Seven. And in fact, we're so oversold that we're starting to get early buy signals. So I think we're actually, if we can have data that's comforting to the market, I think we're in for a rally for the next couple of weeks. And I do think it's going to be led by tech and tech related.
Well, Marianne, I gotta follow on that before we get to you, Dennis. I'll come to you in a second here. But what are you basing the confidence on in the market rally to come in the coming weeks, given that there is potential that the carry trade didn't fully unwind, given that we could see more volatility off of this week's data prints, and that there's still the looming growth scare question in the room?
Well, we did look at the commitment of trader reports for non-commercial, which is really basically your fast money or traders. And that's almost completely closed. There's not a lot of short positions, at least based on that data. Doesn't mean that there's not other positions around the world, but here in the US, it looks like the trade is pretty much closed. So I think volatility can actually come down. So how do I say a buy signal? So that's where we lean on the technicals, and we've looked at the 14-day stochastic. And that is an oversold condition. And remember when we used to talk about FANG? Well, there's an index that's called the New York Stock Exchange FANG Plus Index, which is the Magnificent Seven plus a few others. And that's actually generated a buy signal from the stochastic. So I think this is an oversold bounce. By no means do I think we're out of the volatility range. I am expecting volatility to pick back up again back in the fall months around September and October. But right now, I think we're rallying, which will give investors an opportunity to rebalance their portfolios if they haven't already done so.
So, Dennis, how are you looking at the risk of slowing growth right now and how big of a headwind that could be for stocks?
Well, it could be a major headwind insofar as the tail risk is higher, right? So to the extent that you end up in a negative feedback loop for the economy, which would be related to, obviously, the unemployment rate moving up to 4.3%, to the extent that impacts confidence, corporate decisions, et cetera, you have the tail risk and the earnings tail risk related to a recession. We don't think a recession is a base case at all, but that risk is out there. Time will reduce that tail risk. And when I say time and inline data. So you take this, kind of shorten the time frame, you take this week's data and you look at it, if it were to come mostly in line with consensus, just going on Mary's comments, volatility would come down. Your odds that the normal economic expansion would continue would increase. So you need negative data from here to justify higher recession risk odds, which are elevated. I mean, I don't want to diminish that point. But to the extent that you don't get it, you probably want to be a better buyer than seller of the market.
Dennis, let's talk about your rate call for the Fed. I know you're thinking a 50 basis point cut come September. Talk to me about that call, and to what extent does the market action and volatility that we have seen play into that call?
Great question, in the sense that if you're getting, our call is 50 basis points, as you say, and if it's 50 basis points in a risk management framework, because at the end of the day, you have a 4.3% unemployment rate. You have inflation that is slowing. Hopefully that data is confirmed this week again. And in that context, if you're going to cut 50 basis points and very quickly get back to some level of less restriction in a non-recession scenario, it is very positive for risk assets, all things equal. That's full stop. Now, importantly, if you get 50 basis points with unemployment rate of 4.5%, then it's negative. So when you think about it in risk asset terms, when you think about it in market terms, it's very related to how are you getting the cuts in relation to the way your baseline economic outcomes are developing. In our view, it's going to be non-recession, and to the extent that that happens, you want to be a buyer of rate cuts because it's going to be an important positive.
Marianne, what do you think? Do you agree? And how are you thinking about rate cuts?
So the proxy that I'm using is actually the 2-year Treasury yield. We've been saying for quite some time that rates have peaked both at the short end and the long end of the yield curve. But it looks like a major top is forming in the 2-year Treasury. And if that breaks and stays below 3.5, we can get that rate down to a 2 to 1% handle. And the only explanation I can come up with is that you would have to be in a recession or very close to a recession to get rates down at that level. So we're watching the 2-year to actually signal if the economy is significantly slowing.
Dennis, I want to give you the last word here. If what Marianne was saying that this past week was just leverage getting pushed out of the system, will this week's economic data really be that much of a referendum on the market volatility that we saw last week?
It has the potential to be. I don't want to get over my skis on it, but at the end of the day, you're sitting at a 20 VIX, which is high for any normal economic expansion. So to the extent that you have data that does not confirm fears of a impending recession, it's probably going to be more positive than negative week for markets. So, the way you got to think about this is, what are we going to find out that's new to make the downside risk come to fruition, right? So you're going to have to make a bet that claims will be worse. You have to make a bet that retail sales will be worse. You have to make a bet that housing data is going to be worse. Could be the case, but everything we're seeing from a high frequency point of view doesn't suggest meaningful downside risk from here to the economic data.
All right, Dennis and Marianne, thank you both so much for kicking off this trading week here and what investors need to expect ahead of what is going to be a very busy week here for econ data. Thanks to you both.
Thank you.
Treasury is ticking lower. When we come up, we are going to discuss, yields moving to the upside here. You have Treasury prices ticking lower. What's next for the bond market? We're going to discuss that right after the break.
Stocks and bonds are negatively correlated again for the first time since the 2023 regional banking crisis. Taking a look at treasuries on your screen here, you're seeing the yields are ticking higher this morning after a volatile week for equities left investors seeking safety, slashing exposure to equities at the sharpest rate since the pandemic. Here to discuss what is next for treasuries, we've got Brian Whalen, TCW's Fixed Income Group's Chief Investment Officer and Generalist Portfolio Manager. And thanks so much for being here, Brian. So it seems to me that bonds became the haven trade again last week. Do you anticipate that thesis continuing?
Yeah, we've been saying around here, bonds can be bonds again. You know, the bond market went through a tough period in 2022 with rates rising, kind of settled in last year. We came into this year, you know, particularly in the spring, bonds were yielding about 5%. So they were offering, you know, good carry. But at the same time, more importantly, and to your point, which is the price movement of bonds now is going to be moving in a different direction than risk assets. So, you know, as equities go down, bond prices more likely than not will go up, and it'll kind of provide that diversification to an overall portfolio.
So, Brian, what range do you think we're likely going to be trading in then?
I think we've kind of settled in. You know, we've come a long way this summer. Right, we've come about 100 basis points in the front end. So yields have dropped about 1% since the springtime. And since July 1st, at least in the front end of the curve, the 2-year and the 5-year has come down about 60 basis points and about 30 basis points from that employment report a couple of weeks ago. So this feels about right. You know, there's a couple days in late August that traders want to be in their seat. We've got CPI this Wednesday. That'll be important. The market will be watching that to make sure the inflation trends are in place and that they're on a downward trajectory. And then we've got the Jackson Hole, conference that Powell will be speaking at. So traders are going to want to sit there. And so from now until the next labor report, which will be early September, we'll have about 2 days and we're going to be settling in here in rates. But then long term, we think we're going to be on a downward trend in interest rates. We think, the market over time, over the fall, will start to kind of coalesce around the idea that this economy is slowing a lot quicker than was priced in, at least in the first half of the year. And if we're right with that and inflation continues to come down, the market's going to start to project that the Fed is going to start cutting interest rates at a more aggressive pace than even what's currently in the marketplace.
So what does that mean, Brian, for the average kind of retail investor who maybe has had their money sitting in, say, a high yield savings account for the last couple of years? They're seeing this news about impending rate cuts. What should they be doing with that money in terms of Treasury specifically if they wanted to get into the space before those cuts?
Yeah, sure. Yeah, I mean, you're going to want to be in, the most sensitive part to interest rate cuts are the front end of the curve. So you're talking about the 2-year and the 5-year Treasury. Other kind of high quality bond markets are a good place to go, like investment grade corporate bonds. They should perform pretty well. And so you're going to get about a 4% yield. You're going to get the diversification benefits in case your equities or other commodities go down in your portfolio, and that's what they're supposed to do. Places we'd avoid, though, in the bond market, which is elements of the bond market that are more correlated to equities. And so the easiest place to reference high yield's a great example. High yield spreads right now, you're only getting about a little less than 3.5% more yield in a high yield bond or a high yield portfolio relative to treasuries, which historically is actually not a lot. And so if you think about the kind of our forecast and what's starting to be more people kind of coming into this idea that of a recession might be coming up in the near future. Equities will not do well in that environment, and therefore high yield bonds will probably not do well as well. So you want high quality bonds to provide you that stability.
Brian, going back to what you just said a moment ago, that you expect the Fed to begin cutting rates at an even more aggressive pace than what the market is pricing in. What are you expecting?
I think, look, all spring we have seen manufacturing's been very poor in terms of activity. We've seen small and mid-sized business sentiment and hiring. That's been very poor. Consumer behavior, we've seen a ton of either kind of a pullback in consumer or at least substitution effects. And then over the past couple of months, we've seen it's just time after time again, you just hear companies talking about changes in preferences and a slowdown in the economy. And the one thing we haven't seen, and it was really the whole thing kind of holding up this kind of no landing narrative, was this headline employment number, even though there's a number of flaws about it, in terms of response rates and birth death models and adjustments and all of that, didn't matter. There was a lot of hope out there, and the markets wanted to hang on to that. And then finally, we saw maybe a crack in that number last Friday. And so that has kind of shaken, I think, investor confidence. And you saw quite a bit of volatility around that, although we've settled in. So what you should expect to see is over the next couple months, and it's going to be slow and it might take some time, but you should probably start to see more of a pullback in consumer spending. You'll see growth rates start to come down. More likely than not, after kind of scars of the pandemic, where companies had been unwilling to let go of labor, now that they're starting to hear that everybody else out there is softening and maybe they're letting go of some people, they're not going to be as fearful about cutting people. And then so once that narrative takes hold, you'll probably start to see more companies make layoffs at a faster rate than we've seen in a long period of time, and that will obviously push up the unemployment rate at a more rapid pace than people expect. And that's when the Fed's going to have to react. They're going to have to look around and say, you know what, 5.5%, that's too tight. We're going to start to cut rates. And, we can debate about r-star and what's the neutral rate for interest rates, but it's a long way from here. It's certainly below 4%. And, we would contend it's still below 3%. And if that's the case,
sure,
you've got probably a couple hundred basis points of journey to go downwardly in U.S. Treasury rates, and that could mean price returns of 10% or more in the bond world. And as we started off the segment,
right,
when your bonds are up 10%, more likely than not, that's going to be because your equities are down more than 10%.
Right. Well, Brian, congrats to you and the bond guys for a good week of attention there. Thank you so much for joining us. That was Brian Whalen with TCW. Coming up, we're going to have all your markets action ahead, so stay tuned for more. You're looking at a little bit of pressure across markets here with the S&P down nearly 0.3%, the Nasdaq down about 0.1%. You're watching Morning Brief.
Let's get to some big stock movers on Yahoo Finance today. It's Monday.com, Barrick Gold, and KeyCorp. We're going to do each one in 30 seconds. Let's kick it off. First, we have Monday.com. Shares are rallying today. You're looking at gains of just about 8.5%. Now, this company is a project management software company. It actually beat the street's expectations in its last quarter. It raised its guide, and some of the things that we are seeing, quote unquote, the results signal sustained market share gains and also further inroads in the larger customers as its product portfolio broadens. So that pipeline for their product portfolio, a bullish sign here for investors at this point. Again, this move to the upside taken as very encouraging from the street. So Monday.com, a trender here today.
All right, Shauna, well, I'm going to move on to gold. Barrick Gold in particular shares rising after the mining company beating the street's expectations in its second quarter report. That comes thanks to both a jump in gold and copper prices. This company also issuing a 10-cent per share dividend, repurchasing nearly 3 million shares. But what I really wanted to focus on was gold as its own asset class, hitting its highest levels in a week ahead of key inflation data. It's nearing all-time highs. And I should also mention that gold is already up 19% over the course of this year. So we've seen a massive run, not only due to some of the volatility we saw last week here, but of course the geopolitical tensions leading to that run as well.
All right, let's round it out with KeyCorp because shares are surging. Bank of Nova Scotia agreeing to buy nearly 15% stake. It's valued at about $2.8 billion in the bank holding company. You're looking at gains of just about 12% here. Well, KeyCorp here, one of the regional banks that was hit hard by last year's turmoil. Bank of Nova Scotia doing this as part of their focus on North America. Now, that Canadian bank is the one with the biggest international footprint. Most of their investments, though, have been in Latin America, so they have a push here for North America. Again, the move to the upside in KeyCorp, and that is a stock to watch today. Well, coming up, we are watching stocks edging just a bit lower here to kick off a busy week for the markets. You're looking at the Dow now off 233 points. You've also got the S&P or the Nasdaq as well, flipping from positive territory to negative. We're going to dive into the key catalyst for the markets in the next hour. We'll be right back. Just after 10 a.m. here in New York City, I'm Shauna Smith alongside Madison Mills, and let's dive into the catalyst moving markets today.
Stocks are lower ahead of a key week for economic data. We've got two inflation prints on deck. After the June CPI report, we did see investors rotating out of big tech, and we saw a bit of a rotation into small caps. And then we had that soft labor data that led to the highly volatile week we saw last week, the VIX spiking over 60 at one point. So we'll discuss if we could see a repeat of any of that reaction and what that could mean for investors.
Plus, retail sales could add some volatility to the market this week, as much of the market's recent concern has been about growth. We've also got earnings results from big box retailers Home Depot and Walmart. That is also going to give investors an inside look at the strength potentially of the consumer. We will break down what to watch.
And President Biden is looking to crack down on wasted time. The Biden-Harris administration is launching the Time is Money initiative to address what they call bad service from companies, like long wait times for refunds and hurdles to cancel subscriptions. Could this give us insight into potential economic policies to come from the Harris campaign? We'll discuss the implications.
But first, we have to talk about markets and some of the moves that we saw over the last 7 trading days, because stocks, they are lower this morning, just about 30 minutes here from the opening bell after initially opening higher. And as we start the busy week with inflation data, we've also got retail sales and key earnings reports from Home Depot and Walmart. And this coming after the week that was quiet on data, relatively, but volatile for the market. Soft labor market data and changing rate expectations triggering recession fears and unwinding initially of that yen carry trade. That all happened on Monday. But really, I think what also took maybe the street by surprise was the reaction, that outsized reaction that we saw to jobless claims last week, given the fact that that print is so volatile and often revised. So what should we expect to the reaction to this week's upcoming prints? We want to bring in our very own Josh Schaefer. And Josh, it could be another volatile week.
It could be another volatile week, Shauna. So we started up today. We're down. So confirming the narrative, right? We're in for just another whipsaw week, right, in the stock market. I'm kidding. But I think overall, the main thing strategists and economists are looking at this week is just, last week we were volatile without any data. This week you actually have data, and if jobless claims is going to move the stock market by 1 or 2%, what's a CPI print going to do on Wednesday? Right. Probably a lot. And so right now where strategists feel like we're sort of positioned coming into the week is we're at a point where investors are looking for confidence in the growth story. So that would mean that you would want retail sales probably better than expected. That's not going to concern anyone right now. And then, of course, the inflation story is kind of a straight read-through every time. People want inflation to come down, whether it's a consumer or a trader. And so that is a very straightforward story. But what I thought was interesting is sort of where the risks lie here. And Bank of America said they feel like there's a lot more risk to the market moving very largely if we have a hot CPI print. They don't think a softer CPI print is something that the market is going to move massively on. They think it's more skewed to risk to the downside for the stock market. If we get a hot CPI print, that could be something to point out. And then when it comes to retail sales, it's going to be an interesting one when everyone starts watching that report really closely, because there's a lot of things in there and that's not really a straight read. So I think that will be a little bit more dynamic. It's not as easy as just looking at a number and saying something about the consumer. There's usually more things at play with that one.
Well, and Josh, you kind of mentioned this, but it does feel like the retail sales data could almost be the more defining just for the market this week. Don't freak out, everyone. I'm not saying CPI doesn't matter, but because the question has been about a growth scare and not necessarily about whether or not inflation is slowing fast enough or if it is potentially reigniting, it feels like that retail sales data is going to be perhaps the more critical in terms of the market this week.
Yeah, and something we wrote about over the weekend that sort of stuck out to me, Michael Gapin over at Bank of America pointed this out, saying that if we get, I think estimates right now for the control group, which is the group that goes into GDP that sort of takes out some of the volatile categories, if that only goes up 0.2%, which I think is around where consensus is right now, down from 0.8% last month, it's not necessarily a bad read on the consumer. Remember, you're taking month-to-month data here, so it's not, I guess it's not an easy read through is the point I'm making, and sometimes you have to look at the trend over the last couple months and add that together to get a little bit of the story. But I do think, Maddie, one thing we highlighted in our chart of the day, which I didn't bring up yet and I should be bringing up, everyone should be subscribed to the Morning Brief newsletter and reading our chart of the day every day. We were taking a look at the relationship between bonds and stocks. So what you're looking at here is the 10-year and the S&P 500. For the longest time, we had a pretty clear interaction where rates were falling, that was good for stocks. Rates were rising, that was bad for stocks. Last week, that flipped. You can see that little tick up at the end there. That was off your jobless claims number. And so that's something to watch this week too as an investor, just thinking about what's going on in the market. If yields are rising because people are feeling better about growth, strategists think that is still a productive environment for stocks. That has not largely been the case for a year. So we're starting to flip now. We're not worried about growth being part of the inflation story and growth maybe hurting the inflation story. Yeah. Everyone's rooting for growth now. We're all on the same side. We can stop arguing about good news is bad news, bad news is good news, We want good news.
Right. And
that's the take going into the week.
That's the take. And also bonds are back. That's another fun one.
Bonds are back.
The bond bros
They
out
work
there.
again.
All
They
right.
help your portfolio.
Exactly. All right, Josh, thank you so much as always for joining us. We do appreciate it. We'll be talking with you a lot as we get the data in this week. Let's turn now to another big story that we are watching here, and that is big tech and the Magnificent Seven. You're taking a look at just 4 of those 7 stocks right now on your screen. You've got NVIDIA, Alphabet, Amazon, and Microsoft here. You can see that NVIDIA is moving up to the upside, Alphabet to the downside, and Amazon to the upside here. But this comes after we saw the broader market flipping this morning to the downside after a volatile week for markets, particularly in the big tech trade. Mag 7 lost a lot of value last Monday, but regained some of the losses toward the end of the week. Investors wondering whether we'll continue to see that rotation out of big tech and into small caps that got a bit derailed by the broader market sell-off. So what's next for big tech? Joining us now, we've got Rich Bernstein, the CEO of Richard Bernstein Advisors, joining us remotely. Rich, great to have you on here. So listen, we were just talking about the data prints to come for this week, and I'm curious from your perspective, what is the biggest print that you're going to be watching, and how are you positioning around that?
So, good morning, guys. I think clearly the big one this week is the CPI. We are not event-driven managers, so we are not going to change our positioning regardless of what comes out in that report. We're very fundamentally driven. And I think the biggest story for true fundamental investors, it's not so much inflation, it's not actually the Fed, it's actually earnings, and earnings in the second half of the year. And the reason I bring that up is simply because by the end of this year, analysts in the street are forecasting that small caps, emerging markets, and the world X the Mag 7, as you just referred to them, X the Mag 7, all those groups are going to have stronger earnings growth by the end of this year than the Magnificent Seven themselves. We think that is the big story that's going unnoticed right now.
But Rich, if you take a step back and even just coming off the volatility last week, is it too early given the slew of factors that we could see really drive volatility here, at least in the short term? Is it too early to say that we are in the clear, and do investors very much still need to be on watch?
Oh, well, I think, look, I mean, bond volatility is up, and bond volatility we haven't seen at these levels in quite some time. That's going to translate to stock volatility. There should be no doubt about that. At the same time, the lagged effects of the Fed raising rates and withdrawing liquidity from the financial markets, that's going to have an effect on volatility too. Volatility tends to go up after the Fed tightens, not while the Fed tightens, but actually after the Fed tightens. So we should expect more volatility rather than less. I think that should be the norm going forward here.
I want to go back to what you said about the broadening that you are anticipating and the growth, the earnings growth that we're going to have outside of the Magnificent Seven and small and mid caps, EM, global equities. I wonder, is that a concern? Because so much of the market gains that we did see in the first half of this year were driven by those gains in the Magnificent Seven. Can we still see a happy year end for those S&P price targets if we get the rotation?
Right. Well, we don't make S&P price targets for a reason, and one of the reasons is exactly the issue that you're coming up with. Look, we've described the stock market as a seesaw, with the S&P being the fulcrum of that seesaw. On one side of the seesaw, we clearly have the Magnificent Seven, and on the other side of the seesaw, we have everything else in the global equity markets. Obviously, our portfolios are positioned on that other side of the seesaw. That's where we think the opportunity is. In fact, we described it as a once-in-a-generation opportunity. But you're right. If the Mag 7 comes under pressure and they dominate the indices, and if volatility goes up, it's hard to make the argument that the market, the way people like to talk about it, is going to do well. I think the bigger story is going to be which side of the seesaw you're on, not necessarily the market, the way you described it.
Rich, how does the Fed cut factor into your thesis at all? Does it matter about the timing? Does it matter to the degree that we're going to get the cuts?
Yeah, so that's a key question right now, actually, because normally when profits are accelerating, the Fed is tightening. we may actually get the combination of profits accelerating and the Fed cutting rates, which is very unusual. And so what could happen is that the Fed, by cutting rates, I would argue somewhat prematurely, but by cutting rates, that they fuel this rotation in the seesaw, and that the other side of the seesaw, small caps, emerging markets, all these other things, actually do better than people think because of that added liquidity from the Fed.
Is that side defensive right now, Rich, or is it just where you see the gains heading?
So oddly enough, you could make the argument that things like small caps could be defensive. I mean, that sounds ridiculous, right? Off the top, how could small companies be defensive? But if you look back after the tech bubble, when we also had this tremendous imbalance, sort of the seesaw effect, in the years that happened, and even as the Fed tightened subsequent to that, very cyclical sectors and small caps did prove to be defensive. And the reason why was the seesaw effect, and the rebalancing of the seesaw became more important than maybe the economic fundamentals.
Rich, before we let you go, I also want to talk with you quickly about some of the notes that you sent over about the opportunity that you're seeing outside the Mag 7, but even beyond the small cap space. You also made the case that industrials, it's the best long-term investment sector too, and that it's much better than AI themes. Talk to me a little bit more about that and why.
So it's at Richard Bernstein Advisors, RBA, at our firm, we always live by the rule that you want to be the one banker in a town with 1,000 borrowers. Think about that one banker in a town with 1,000 borrowers. He or she is going to mint it because they're going to set the interest rate on every loan. Turn it around, right? 1,000 banks, one borrower. The borrower makes out like a bandit and gets an extraordinarily cheap cost of capital. It's hard to argue if you're investing in AI right now that you're the one banker in a town with 1,000 borrowers, right? Long-term returns are purely a function of the supply and demand of capital. And with AI right now, you've got an oversupply of capital, right? Where do you not have that? It's actually in deglobalization and the reindustrialization of America. I mean, everybody understands, here's a way to think about it in one sentence. Everybody understands the national security implications of the United States being dependent on the rest of the world for semiconductors, but why do we not understand the risk of being dependent on the rest of the world for everything? And so as deglobalization takes effect, the United States economy is going to have to reassert its independence, which we think the industrial sector is the key component of that independence.
Rich Bernstein, we really appreciate you taking the time to join us here this morning. We hope to also have you back soon. CEO of Richard Bernstein Advisors. Thanks so much.
Great, thank you.
Stocks are mixed in early trading, pulling back from last week's late rally after weaker than expected jobless claims helped reassure investors that maybe the economy isn't heading for a recession. But the market, though, clearly still on edge, and key data points on inflation and retail sales this week are going to give investors potentially a better idea of the Fed's next move. So here to talk about that and more, we want to bring in Thomas Simons. He is Jefferies' senior U.S. economist. And Thomas, it's great to have you here on set with us. Thanks so much.
Great to be here. Thank you.
So let's talk about what is going to be a busy week here, at least on the econ front. When you take a look at the inflation prints, take a look at retail sales, what's the most important print to you this week and why?
So very close race between CPI and retail sales, obviously, but I think for once, and this may be a recurring theme amongst commenters here, retail sales actually edges out CPI a little bit because we're so kind of keyed off on whether or not we're going to continue to see strength from the consumer and whether or not that's going to drive growth on a sustained basis, right? The risk is, though, that we have to remember exactly what retail sales are telling us, right? Which is mostly about goods spending, which since 2021 has been quite weak, right? Also, as it relates to the kind of breakdown of different types of consumers on the income spectrum, upper income spenders seem to be driving overall growth, and most of their spending seems to be focused on services. So it's possible that we get a little bit of a weaker head fake with this data. I'm expecting it's going to be relatively soft outside of autos, rebound from last month when the cyber attack screwed things up with June. But in July, I'm expecting we're going to see a pretty decent headline, but probably some softer details under the hood.
Are those softer details under the hood something that you think will drive the Fed more moving forward, or do you think it's still about that super core number?
I think that the Fed is positioned to likely cut at the next meeting, and I don't think that they're particularly keen on going big and bold, or certainly not going intermeeting like we were talking about early last week. But I mean, it'll definitely add some credence to the idea that they should be withdrawing on the restriction that's on the economy.
What do you think the pace of cuts is going to look like? And then I guess ultimately, what does that then tell us about maybe this overreaction that we clearly saw play out in the markets last week?
Right. So, I mean, I've always been kind of on the more conservative side with thinking about the Fed, and I've just tried to kind of trust what their guidance is specific to this. And, they have a relatively shallow path that's in the last SEP. Granted, we've gotten a lot more information about the economy since June, and we're going to get an interesting update on this in a few weeks at the next meeting. But I think maybe they go twice this year, 25 basis points apiece, and then I'm only expecting at this point maybe 50 basis points of cuts in each of the next 2 years as well. I think the Fed needs to be very, very careful about, understanding that rate cuts could spark some significant demand in areas that are interest rate sensitive, right? So, for instance, housing. Last October, after Powell said that they weren't going to raise rates anymore, that was essentially the bottom of the housing market, right? We had this little correction in prices that began last spring, literally ended in October, and prices have been up every month since. So that's only with them saying they're not going to raise rates anymore. If they actually start cutting them and then expectations start to get built in and mortgage rates drop, another 125, 150 basis points, you could see shelter rise quite a bit. And of course, as we look at the inflation data recently, shelter has been one of the bigger drivers of disinflation. So if you kind of eliminate that, then they're in a tough spot.
Given that, if we do see more cuts than your call calls for in that time period, would that be indicative to you of some sort of sickness within the economy that the Fed was working to address?
Yes, it would. My view is more or less that the economy is still in pretty decent shape overall. Certain sectors are doing a little worse than others. Certainly manufacturing and housing too. Yeah. They will probably do a little bit better with modest rate cuts. But this is about maintaining a balance and trying to make sure that inflation doesn't get away from their control once again, right? I mean, we've been in this spot not that long ago. So if things are starting to unravel in some way, or the labor market's starting to do quite a bit worse, then I would be very happy to pencil in more cuts. They certainly have a lot of room to provide some accommodation. It's just that, at this point, I'm as data dependent as they are, so I'm willing to change, but not just yet.
Thomas, what is your assessment of the labor market? Because we did see a weakening when you take a look at the July print, when you take a look at jobless claims that helped reassure the markets last week. Some of those concerns about weakness, has that been a bit overdone? And what are some of those key factors that you're looking for?
So I don't necessarily think that monitoring weakness is necessarily overdone. We do seem to be kind of at the top of the cycle for the labor market. It's just a question of how quickly it's going to unravel, right? I mean, certainly a lot of talk about the SOM rule last week, and how we've seen the unemployment rate rise quite a bit from the trough, but so far things haven't really accelerated in a way that's particularly troubling, and labor market data, as it's softening, is really showing the market coming into better balance, right? I've been looking at some data for several months thinking I can kind of characterize the labor market as no hire, no fire. Which is not great if you are entering the labor market, but is not the worst if you are currently in the labor market. So, for now, until financial conditions ease some more, I think that's very likely what we're going to continue to see from businesses. It's just a very cautious approach to adding to payrolls, but also mindful that it took a lot of effort and a lot of money and excess investment in order to hire the people that they currently have.
Really quickly here, Are you seeing evidence of the low-income consumer weakness that we've been talking about? Are you seeing evidence of that creeping up into middle and higher-income consumers? And I reference that particularly as we're ahead of some big box earnings this week as well.
Yeah, it's interesting because we all seem to kind of have this good idea about the dichotomy of upper-income and lower-income folks, but there's very little data that actually supports it. So it's mostly news stories and anecdotal reports that we're kind of going on, and up until last week, I would have said no. I think that mostly upper and middle income folks are doing fine. I think if we start to see some more weakness in the labor market, I would start to worry about that middle class. But there were some stories last week about some weakness in the travel and entertainment and leisure sector, right? Like a lot of places are kind of year on year is a tough comp because last year was really, really strong, but they are softer, seeing softer attendance and softer spending. So to me, especially as we see the overall consumer sector driven by, as I said, upper income earners kind of, living it up with services. If they're starting to pull back, then that's quite worrying for the overall kind of aggregate spending numbers.
All right, Thomas, thank you so much as always for coming in. We always appreciate you coming here.
Of course.
So thank you so much.
Likewise.
Again, Thomas Simons, Jefferies senior U.S. economist. Coming up, we'll continue to have all of your markets action ahead. Markets flipping back to the upside here. The Nasdaq up 0.5% and the S&P holding on to some gains as well. We'll cover all that and more next. This is Catalysts. Let's take a look at some trending tickers here, starting with shares of Robinhood moving higher over 3% this morning after Piper Sandler upgraded the stock to overweight from neutral. The analyst citing the result pullback as an attractive entry point and saying Robinhood will benefit in the long run from continued growth in global retail and derivatives trading, among other things here. Now, I also want to note that we do have some executive changes coming in here. We've got a new technology chief, Jeff Pinner, joining Robinhood as of today. We're getting that news in. We got that in about an hour and a half ago. But it's interesting that Piper is talking about this as an entry point. And this mirrors what we've been talking about throughout our show, is the entry points that were created based on the sell-off over the course of the last week. Again, in Piper Sandler's note, they're talking about the pullback as an attractive entry point, and that they also expect longer-term growth here, not just because of the generational impact of retail trading and investing and the popularity of that, but also because of crypto in particular as a potential catalyst for the stock moving forward.
Yeah, exactly. This is an interesting call, just given the fact that they only really lifted their price target to $23 from $20, but again, getting much more bullish on this name given where we are trading today, and it's right around just above $18 a share. And as they go on to point out some of those opportunities within Robinhood right now. They discuss crypto. They discuss that international expansion. They say that Robinhood is very much still in the early stages of that. And then looking even beyond some of those longer term catalysts, just point blank, like you were saying, this pullback that we have seen in the name really providing an entry point. And I think that really has been almost consensus amongst strategists, amongst analysts here of some of those beaten down names and names that got caught up in the volatility trade last week that have been maybe oversold right now, representing a buying opportunity. We talked to a chips analyst last hour. He was talking about some of the opportunity within NVIDIA. Take a look at a name like Robinhood, very different from NVIDIA, but again, when investment thesis wise. But again, when you take a look at the call that's being made, the valuation play right now, again, they're saying that that pullback that we have seen, you can see that dip on your screen just about a week ago. And then even over the last month, it's still off nearly 17%. So again, Piper Sandler here is saying that there is reason to believe in Robinhood at this level. And they did raise a recommendation to overweight from neutral. Let's take a look at JetBlue because shares are sharply in the red, off just about 13%. The company announcing plans to raise at least $2.75 billion in capital through separate debt offerings. Now, the majority of it is backed by its loyalty program, TrueBlue, and is a part of an attempt to improve liquidity. So it's also good to point out that this has been a playbook around for airlines now for quite some time. When you take a look at what happened during the COVID-19 pandemic, you had Delta, United Airlines, both leveraging their loyalty programs in order to help enhance some of their cash reserves during those challenging times. So JetBlue turning to this tactic in hopes of boosting their business. We know that they have been doing everything they can to right-size the business right now under their new CEO. They've been trying to cut costs. They pushed out some of the deliveries of their Airbus jets. They've also been planning to reduce CapEx expenditures by about $3 billion between 2025 and 2029. So again, they're pulling this lever in the hopes that this is going to better position JetBlue here for the future.
Yeah, and it's important to note that they did officially kick off that $2.75 billion bond and loan sale backed by that loyalty program that Shauna mentioned. But also we should note that this is not the only news for JetBlue that could be pressuring the stock, because we also know that Moody's ratings downgraded JetBlue here. So that is also a part of potentially the movement that we are seeing, downgrading it, saying that restoration of operating profit and cash flow to levels that would lead to materially stronger credit metrics will require a number of years. So the combination of this debt offering and that Moody's downgrade putting pressure on the stock. And again, as Shauna was mentioning too, this is a company that has been under pressure and under a period of transition, particularly with the new CEO in place, and that could potentially be adding to the movement that we're seeing in the stock. Let's get to another trending ticker here. Shares of Bank of America after Wolfe Research getting more bullish on the bank. The firm reiterating the bank as a top pick and saying the recent sell-off in the stock is, quote, unwarranted. Analyst Steven Chubak saying Bank of America has more room to grow even in a more aggressive Fed easing cycle. And I think it's really interesting given the impact that we saw after the announcement that Warren Buffett had been selling off shares of Bank of America in particular, which, you know, you were so great at putting into context, Shauna, just that was not massive compared to his overall holdings in Bank of America, but that did potentially lead to an unfair amount of pressure on Bank of America stock. And I think that's an interesting way to kind of look at it, given that, again, as you can see on your screen here, this is a stock that is up 13.5% year to date.
Yeah, they're saying that they like the current valuation right now of Bank of America, and they lay out what is a bullish thesis here for the company going forward. They say that Bank of America, it operates the leading retail banking franchise in the U.S., also continuing to benefit here from that steadfast commitment to responsible growth. They also went on to say that they expect Bank of America to actually benefit from the idiosyncratic net interest income tailwind. So what does that mean? They're talking about asset repricing, they're talking about hedge renewal, they're talking about liability optimization. So again, they think the setup here for Bank of America is very constructive, and of course, after the recent turmoil that we have seen within the stock.
All right, well, we're going to continue to cover all of your markets action ahead, so stay tuned for more. You're watching Catalyst, and you are watching more movement to the upside. You've got the Nasdaq up squarely over 0.5%.
Oil prices rising for the 5th trading day in a row on fear that escalating conflict in the Middle East could impact oil supplies. Here with more, we want to bring in Andy Lippow. He is Lippow Oil Associates President. Andy, it's great to talk to you. So when you take a look at the conflict that has played out in the Middle East since last October, we haven't yet seen any disruption to supplies. Is that at risk of changing?
Well, I think it is at risk of changing, although the probability of it happening is probably still pretty small. The market is certainly concerned about this escalating tension between Israel and Hezbollah across the Israel-Lebanon border, and whether that could ultimately result in Israel striking at facilities in Iran. But I don't think that we're going to see a Strait of Hormuz being shut down or things like that, but the market is pricing in additional geopolitical risks that such an event could occur.
And what does that look like for you long term? You know, if that event were to occur, where do you anticipate the price of oil going as we head into the end of this year?
Well, if we were to see the Strait of Hormuz shut, where about 20% of the world's oil supply transits, you certainly could see oil prices rise $30 or $40 per barrel. But I'm certainly not anticipating that. I think that Brent prices, which are currently $80 a barrel, will drift on up to $85 to $90 a barrel, as these lower prices are really going to force OPEC Plus's hand to delay the restoration of their production cuts, which they had announced earlier this year.
So, Andy, I guess as the market stands right now, given the supply picture that we do have, given the output that we're getting here from North America, it sounds like the oil market, at least here in the short term, you think could potentially offset or be able to discount any sort of supply disruption that we could see. Is that right?
Well, I certainly think that is the case, especially with the EIA reporting last week that the United States produced a record 13.4 million barrels a day of oil. And you combine that with additional supplies out of Canada, Brazil, and Guyana, and you marry that against faltering demand, if you will, or demand that's not growing as fast as the market would like out of China, creating, a more or less supply-demand balance, which is really weighing a little bit more on the supply side.
Well, it's interesting, and the other thing that comes to mind when I look at oil from a geopolitical perspective, it's not just geopolitical tensions and foreign policy issues. It's also currency volatility, which certainly drove a lot of the market movements over the past couple of weeks here. How much could a continuation of that currency volatility start to impact the price of oil?
Well, we certainly see that as the U.S. dollar strengthens, that tends to put pressure on oil prices. But when geopolitical tensions are considered and oil prices rise with a stronger dollar, this really puts stresses on countries and economies around the world, from Latin America to Southeast Asia to elsewhere, who have to pay for their oil in dollars while their currencies weaken relative to the dollar.
All right, Andy, thank you so much for joining us. We really appreciate it, and thanks for bringing us your insights. That was Andy Lippow.
Thanks for having me.
He is Lippow Oil Associates President. Coming up, we're going to continue to monitor all of your markets action ahead. You're looking at continued gains across the S&P and the Nasdaq, with the Nasdaq hitting gains of 0.7% at the moment. Stay tuned. You're watching Catalysts. Deutsche Bank getting bullish on Eli Lilly, lifting their price target on the stock by $300 to a total of $1,025 a share. This comes alongside a rating boost from a hold to buy. Deutsche Bank noting the high growth outlook for Eli Lilly in the call. So here with more, we've got the analyst James Shin joining us. James, thanks so much for being here. So explain to me, talk to me about the biggest driver behind your call here.
Good morning. Thanks for having me on. The biggest driver is just improved visibility. They had outsized expectations and they beat them. And surprises such as ex-US strength from Mounjaro, the coming out of FDA shortage, and then our analysis into injector data for Lilly shows that they've already met their benchmark goals of meeting 1.5 times sellable doses. And this is a great backdrop, right? Demand outstripping supply, you're selling everything you got. It's just a good story. And the growth, like you said, is outsized.
So James, what do you think that supply picture looks like? And I bring that up because clearly they are taking steps in order to better address the supply issues that they have had, seeing it or expecting it to improve here in the second half of the year. How confident are you that they could quickly get these new operations online? And also eventually, what does that timeline look like? Are they ever going to be able to meet that demand?
So, the CEO on media saying that supply is going to improve, and it did. And it has. The FDA website shows that all the doses are available. And Lilly has cautioned though, look, you can't walk into your pharmacy and get anything off the shelf right now. It's just they're bridging towards meeting real-time demand. It's still taking some time. It's like an Olympic track race, right? Them and Novo are trying to meet this demand as fast as they can. They're building new facilities. They're putting billions of dollars into the ground. So it is improving. And like I said earlier, we've looked into the injector data. It looks like they've already met in our view, their sellable doses goal of a 1.5 times increase versus last year. So I think they're in a good position to meet demand in the second half. And guidance also implies acceleration in the back half. So we feel pretty good.
James, how are you thinking about any potential policy changes to come with the upcoming November election and how that could impact? I know you cover a lot of stocks within the healthcare space, but specifically Eli Lilly.
So Eli Lilly, as it relates to the election, it's tough to say. I think more people will be looking towards the PBMs and so forth for the election. I think there's a bigger correlation there than there's to pharma. Look, anything that's on pricing is obviously a negative headwind, but we already have Inflation Reduction Act. Whether that gets reversed or not, who knows? I think both sides, whether you're red or green, had some issues with how medicine is done in the U.S., but we'll see. That's a TBD.
James, how are you looking at competition? And is there one drug or one, I guess in pill form or whatever it is, that you view as the biggest threat here to Eli Lilly at this point?
So yes, competition is indeed coming, right? This is a big market, lots of opportunity to go get in after. In my view, I think an oral that is non-peptide based, and the one that comes to mind as of late that's making headlines, I think, is Roche. Roche has a product called CT996. Roche is covered by my colleague Emmanuel. They'll be presenting data at a medical conference coming up, so all eyes on that.
And what is it specifically about Roche? And the reason I ask is to kind of broaden it out, because I think a lot about the kind of direct-to-consumer brands that are selling weight loss drugs that are compounded, that they are not coming from an FDA, they're not FDA approved, but they're coming from an FDA approved pharmacy, for example. How do you think about competition in that context?
So the compounders are enabled, I think they get leeway, right? Because there's a shortage from the branded products. So as that improves, that leeway starts entering into a gray legal banner. But to your point, having these orals and so forth come to market, they don't have the manufacturing constraints, especially if they're non-peptide. So it'll help to better serve demand. So eventually this, I think the compounding business, we'll have to see. Compounding isn't bad, right? It serves a purpose, right? They're trying to address patients that have specific needs that can't take a specific formulation. So it's really hard to say.
All right, James Shin, great to have you. Thanks so much for your insight here this morning, analyst with Deutsche Bank. We appreciate it.
Thank you.
The Biden-Harris administration is launching a new regulatory initiative. They're cracking down on what they call corporate tricks and scams. Here with the details is Yahoo Finance's senior columnist, Rick Newman. And Rick, what can we expect?
Well, I guess this is a continuation of the war on junk fees that we've seen out of the Biden, I guess we have to call it the Biden-Harris administration now. So this is meant to make it easier to do things like cancel subscriptions, get a customer service person on the phone. I mean, all the things that drive a lot of people crazy that just seem like they're way more complicated than they need to be. So, I mean, this is, in the whole scheme of things, this is small ball. But, Biden has been making a point of going after these sort of everyday nuisances. I don't know when we're going to see any actual changes. This has to go into a rule-making process through agencies such as the Federal Trade Commission. It does not require Congress to pass laws, so these are things the administration could do on its own. And is it a coincidence that this is happening 3 months before the election when Vice President Kamala Harris is just trying to get elected? No, it is not. Clearly, this is something that Kamala Harris wants to be able to tell voters she's going to be able to do. And if she does get elected, maybe we'll start seeing some of these changes by the time she takes office next year.
Well, Rick, is this indicative of any potential further economic policies that we could be seeing from the Kamala Harris campaign moving forward?
I think so. Kamala Harris has said, yes, she knows, she realizes that she does not have much of a campaign platform of her own out there. I mean, obviously, she's associated with all of Joe Biden's policies, but she has said she is going to start putting out some of her own economic policies beginning this week. She's going to have to go a lot bigger than, cancellation wait times and things like that. I mean, there's a lot of big stuff on the table. The assumption is that she's basically going to be exactly where Joe Biden is on the big issues, such as what to do about the tax cuts that expire in 2025. So I think what everybody's going to be looking for is whether there are any areas where she actually differs from Joe Biden. There are no major differences I anticipate, but she could surprise us. So we're going to be seeing that probably later this week.
Well, Rick, let's focus on the U.S. economy as we have been here. But according to a recent poll, Vice President Harris does appear to be winning voters' trust over her candidate. Tell us a little bit more about the narrowing in the polls that we're seeing.
So a couple of things going on here. She is obviously, she has had about as good of a launch as you could possibly hope for if you're a Democrat. She is leading Donald Trump in some national polls and in some swing state polls, which is huge improvement over where Joe Biden is. I mean, it is really unusual to see abrupt changes in polling in such a short period of time. And now the Financial Times just did a poll, and they found that people trust Kamala Harris on the economy more than they trust Donald Trump. I mean, I'm kind of shaking my head, honestly, because she hasn't even done anything on the economy. I mean, as we just discussed, we don't even know what her economic policies are. And now voters are saying, oh, they trust Kamala Harris. It's only 1 percentage point more. But that was one of Joe Biden's two giant vulnerabilities, the economy and immigration. And now this tells you that voters are not really looking at what the candidate's policies are. It's just a feel. It's just a feel. So there's something about Kamala Harris that is making voters feel good. That should really worry Donald Trump, because if voters don't think he's going to do better on the economy, that leaves immigration. And, in most elections, it's not immigration stupid, it's the economy stupid, as James Carville said all the way back in 1992. So this is great news if you're Kamala Harris. I think the only question is, how does she keep this momentum going and keep it going for the next, I think it's 85 days until we get to Election Day.
All right, well, we'll be talking to you for every single one of those 85 days, Rick, which I'm sure you're thrilled about. Thank you so much.
I don't know if you guys are, but I am. See you guys.
I'm thrilled. I can't wait. Thank you so much, Rick.
Bye.
Coming up here, Tesla appears to no longer be selling its most affordable Cybertruck. Is this the right move for the company? We'll discuss what's behind it next.
Originally inspired by General Motors ending its EV1 program, Tesla has become the world's leading electric vehicle manufacturer. In 2023, Tesla generated nearly $97 billion in revenue, and its market cap is over $570 billion. The company was Yahoo Finance's top trending ticker of 2023, with over 300 million page views. Let's take a look at some of the company's biggest moments with Beyond the Ticker. Originally named Tesla Motors, Tesla was founded in 2003 by Martin Eberhard and Mark Tarpenning. Elon Musk joined the company in 2004, investing over $6 million of his own money and becoming chairman of the board. In 2006, Tesla unveiled the prototype for its Roadster, which entered production in 2008. It was the first all-electric car to use lithium-ion battery cells. After co-founders Eberhard and Tarpenning left the company, Musk took over as CEO in 2007. On June 29, 2010, it went public via IPO on the Nasdaq at $17 per share. In 2016, Tesla unveiled the Model 3, its first mass-market vehicle. Later that year, Tesla agreed to acquire SolarCity for $2.6 billion. On July 6, 2017, Tesla's stock crashed after delivery concerns. The company lost more than $12 billion. Defying expectations, Tesla recorded 4 profitable quarters in a row from 2019 to 2020, making it eligible for inclusion in the S&P 500. On November 4, 2021, the company reached an all-time high stock price of $409.97. Originally introduced in 2019, the first Tesla Cybertrucks were delivered to customers in November 2023. Tesla continues to produce despite its setbacks due to lawsuits, manufacturing delays, and Musk's controversial statements. Investors will continue to wait for the next wave of innovation from the world's most valuable automaker.
Tesla has stopped taking orders on its website for its cheapest Cybertruck that retails for roughly $60,000. Now, the least expensive model on the site has a price tag of about $100,000, excluding the EV tax credit. Here with more on the change, we've got Yahoo Finance's senior autos reporter Praz Subramanian. So, Praz, $60,000 to $100,000, that's not a small bump up there.
No. I mean,
Yes, that is a significant, I wouldn't say price hike, because it was always on sale, that $100,000 model. So what's happening now is apparently they're not letting you order that $61,000 cheap model. And the thinking is, I spoke to analysts at Guidehouse Research, and they think that the reason why is because their conversion rate is so low for the current $100,000 model that they think that people are waiting for that cheaper model, and because of that, they have so much supply now. There's reports of supply building up in parking lots of Cybertrucks. So I think Tesla's probably thinking we got to get rid of these first-year models now before we can drop the price again.
Do they have any idea of what the demand is going to look like for $100,000? Because we talk about the fact that the economy could be slowing, that consumers are pulling back on spending. $100,000 for a vehicle is a heck of a lot of money.
Yeah, for a pickup, like a fun adventure type vehicle. You know, we saw that Cox put out some numbers for the Q2 EV trucks and EV sort of vehicle sales, and the Cybertruck was the top selling EV pickup, around 8,700 units. The F-150 Lightning was around 4,700, and the Rivian was 3,300. So they are beating their competition, but these are small numbers, right, compared to Ford selling hundreds of thousands of regular F-150. So these are small numbers. It's still good, but you're right, they can't get that mass scale. And they want to build 200,000 Cybertrucks per year. How are you going to sell all of them at that price level?
How realistic is that?
I don't think it's very realistic to think that you could sell 200,000, $100,000 Cybertrucks. I think we're going to see that price come down. We know Tesla likes to play with pricing, so you just got to wait. But right now, they're thinking to themselves, we got to sell more of these expensive trucks.
Yeah, because there has been a number of stories about the Tesla Cybertrucks piling up in parking lots or sold everywhere. So it'll be interesting to see what this does ultimately.
Our own director, Michael Sterling, saw a big lot full of Cybertrucks in New Jersey.
Michael, get video.
I know. We can throw out the pictures next time. All right, Pras, great stuff. Thanks so much. Let's take a look at the markets here. Just about an hour and a half into the trading day. You're actually looking at gains now. The Dow just above the flat line. As I talk, it actually flips back below. You've got the S&P holding on to gains up just about 0.4%. The Nasdaq, the leader here today. We had been lower briefly in earlier trading, now trading to the upside. Of course, the moves today coming ahead of what is going to be a very busy week on the econ front. We're going to be getting 2 readings on inflation. We'll also be getting retail sales print later on this week. So, of course, investors are going to be closely parsing through those numbers, trying to figure out what ultimately any of this means for the Fed and the rate cut path going forward.
Well, coming up, we got wealth dedicated to all of your personal finance needs. Our very own Alexandra Canal is going to have you for the next hour, so stay tuned. Welcome to Wealth. I'm Alexandra Canal in for Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, investing after a volatile week. I'll talk to one financial advisor about how to handle all the noise and make the best decisions for your portfolio. And we'll talk about zero balance budgeting, what it means and how it can get you closer to your wealth goals. Plus, tips for landing your dream job. We'll talk to a resume and career expert about what you can do to succeed. But first, markets are looking to regain footing after a tumultuous week on Wall Street. The unwinding of the yen carry trade and a softer than expected jobs report spiked volatility in markets, causing investors to hit the panic button and price in higher odds of a recession. With uncertainty still lingering, how should investors be positioning their portfolios? Here to weigh in is Liz Miller, founder and president of Summit Place Financial Advisors. Liz, thank you so much for being on the show today. As we know, August, typically a very volatile month for stocks, but it does seem like things are heightened even more so this year amid the TBD factor of the Fed, the election coming up as well. What do you make of the action that we've seen so far?
Thanks. I don't think the action is surprising. And you said it, August always has been a volatile month. And I think the main reason is there's a lot less volume. We've all taken holidays and vacations at different times during the month, and small bits of data end up having outside influence. And so we could have said at any point at the beginning of this year, as we've spent the last 6 months, that the strong market was probably due for some sort of pullback and a little bit of volatility. And we could have been taking bets as to what was going to kick it off. This time it was that employment report that was sort of surprising and seemed out of step with trend.
And Liz, there's been a lot of recent calls for a recession, this overall fear sentiment in the market that bad news is bad news again. What's your advice to investors when they're looking at their portfolio? Should you do nothing? Should you rebalance? What are you telling some of your clients?
So we always tell clients that the summer is a great time to rebalance and reassess. We do not see a recession risk. And even when we look at this recent employment report, if you look at it in the context of the last couple years, yes, employment growth, new jobs has been slowly coming down the last couple of quarters, but it's still way above levels of employment prior to COVID. So we really had that post-COVID spike. And so it's always, statistics are great. How do we cut the data? In the short time we look at, it looks like these numbers are slowing. But if we look over 4 or 5 years, we see employment in the US is really healthy still. So I'm not concerned by that one data point. But I always say summer is a good time to reconsider where you're invested and use some of this volatility that is inevitable to buy things you like or start looking at prices of things that you haven't been in.
So I want to talk about that. When we think about the dips in the market overall, what are the 3 or so dips that you would recommend to buy right now?
So in this market, I think we're talking about some good stocks that are interesting in this dip. And I would say, I really think as rates come down in the future, construction and housing is going to do well. And it's a large cap, but not well-known stock is Martin Marietta Materials, symbol MLM. They make crushed rock. It's a great buy. It's trading at a discount to the market right now. It's come down, and their products are going to be used in any type of construction across the United States, whether it's residential or commercial. So I really love that. In the financial sector, we like BlackRock a lot, another stock that's had a pullback in this dip, and they're very well positioned to benefit as the market rebounds. And they're also getting into some more active management kind of funds that I think a lot of investors are going to like.
Okay, so financials, construction. What about tech, especially when you talk about a name like NVIDIA? We have earnings coming up at the end of the month. We've seen some pretty wild swings there. What do you expect from those earnings? And do you think that'll be the next catalyst for big tech?
So certainly we're all watching that NVIDIA earnings. NVIDIA is a name we've owned for many years. It's up another 5% today. So we could have been saying, was it a great buy below 100? And it probably was if you haven't been in it. But I think you do have to keep watching valuation. It is the ultimate shovel to the gold rush, but they're real. They've got real products. They've got real sales. They've got real earnings coming through that excite us. So I do think there's plenty of runway for NVIDIA, but all of us are trying to assess what is the true value of this technological revolution called AI. If you don't own NVIDIA, by all means, watch the dips, but always know you're owning a very volatile stock. It has a history of always being volatile, even before the most recent run.
And NVIDIA shares are up more than 5% today. Some great advice there. Liz Miller, Summit Place Financial Advisors founder and president. Thank you so much for joining us.
Thank you.
Gold climbing higher today, now approaching $2,500 an ounce. The precious metal has risen over 20% so far this year, and our next guest says it may have even more room to run. Joining me now is Mike McGlone, senior macro strategist at Bloomberg Intelligence. Mike, thanks for being here. I want to start on the catalyst for this run-up that we've seen in gold, and there has been quite a few, but what's really fueling this rally in your view, and is now still the right time to buy?
Well, I think gold is just a matter of time it gets to $3,000 an ounce. It looks like it's put in a pretty good support area around 2,000. It's probably raising that up around 2,200. And a little bit contrarian to your previous guest, to me, gold is indicating there's bigger problems with the macroeconomy. On a year-to-date, 1 year, 2 year, and 3 year basis, the rock is beating stocks. It's beating the S&P 500 total return. It means something. But I think the key thing to remember about gold is to mention why it's going up. You have to start with the unlimited friendship that started with President Xi and President Putin in 2022, and then Russia's invasion of Ukraine. That shifted the world order, tilted towards gold. The deepest pockets on the planet have been buying gold, i.e. central banks. And one thing that's been significant has been big outflows in gold. ETFs have been selling, but just the last few months, they started turning upwards. So I think what people are realizing is this risk-off asset is probably likely to continue, particularly if we tilt towards the U.S. recession and U.S. bond yields. Looks like they're peaking from pretty high levels, just looking at things like 200-day moving averages.
So you said you see gold quickly approaching $3,000 an ounce. When do you think that will happen? And is that the ceiling for you? Where do you see gold pricing, the ceiling topping out?
So I'm be honest, I didn't say quickly, but I think it's just a matter of time it gets there. I don't know how long. It's one of those lessons I learned as an ex-trader, ex-investors. Don't put time and price together. I'm going to continue to go higher. I think the key catalyst for gold to potentially go higher is when we have some further back and fill in the stock market. The mantra I've been saying for almost 2 years now is why buy gold with U.S. Treasury T-bills at 5% and the stock market on a tear. Well, that seems to be shifting. And one key indicator is volatility. Look at the VIX Volatility Index, the 200-day moving average. It's bottoming right now in the process of bottoming from the lowest level since 2018. So stock market volatility is mean reverting higher. Stock market prices are probably reverting downward a little bit for this elusive recession that hasn't happened yet. And gold has been the main outlier. So I'll end with this. The Bloomberg Commodity Index on a 1 year basis is actually down. And you mentioned gold's up almost 30%. So that is a pretty severe global deflationary trajectory. Industrial metals were up about 24% this year. Now they're down. So I don't see what ends it. I think it's risks that it's going to accelerate.
Looking at some other commodities there, you see oil falling further this year. Crude is up just about 8% since the start of the year. So what's your thesis behind the drop there and where you see oil prices going over the long term?
Oil is succumbing to the high price cure that affected natural gas. It went to 10 and back down to 1.5. Expected corn that went up to 8 and back down to 4. Soybeans that are dropped below 10 today. It's just a matter of time. We think it gets near or below its cost of production in the largest producer in the world, which is the U.S., around $55 a barrel. What's holding it up right now is obviously geopolitical issues. OPEC has been a major pulling off a major amount of supply, but that OPEC excess spare capacity is roughly matching the excess of supply and demand out of the U.S. and Canada. So OPEC, to me, crude oil is a bear market, but one issue is the hedge funds are on top of it. Managed money net positions have sold out completely. In Brent and petroleum, the lowest managed amount of net longs in petroleum positions in our database since 2011, which is somewhat of a buoyancy factor for crude oil. But to me, it's a matter of time it gets down to that low price cure, particularly if the U.S. stock market rolls over with higher prices and lower volatility. We need some kind of supply shock. And if we do get that, it spikes crude and accelerates a global recession, which is what we're seeing for most other commodities.
A lot to watch there in the commodity space. Mike McGlone, senior macro strategist at Bloomberg Intelligence. Thanks for being here. Investors are calling for the Federal Reserve to cut interest rates at its next meeting in September. Nearly 50% of traders anticipate a 50 basis point cut, while the other half see a cut of just about 25 basis points. But what could all of this mean for your checking and savings accounts? Here with some answers is our very own Carrie Hannon. Carrie, what should consumers be aware of heading into that critical September meeting?
Yeah, absolutely. Here's the thing. It's going to, if you have adjustable rate interest rate on your credit cards or your mortgage, these things are going to be impacted if they cut rates. Now, what happens is, the important thing to do right now, if you anticipate this rate cut, is to lock in some good rates right now. I mean, you could lock into a 9-month or a 1-year CD. Online savings accounts are still, and CDs and money markets they're paying around 5% now, which is really quite nice and well above inflation. So I would suggest that's something they should consider, because these will tick down as the rate cut comes upon us. Now, this is just personal opinion, but banks tend to anticipate a lower rate, so they may get at this earlier than September to start trimming back some of their interest rates, and they're slower to raise them back up when the rates are up. So just keep that in mind. If you're a retiree, though, or near retirement, you might not want to lock in for quite that long if you think you're going to need that cash for living expenses. So be wary of that, because if you're in a 1-year CD and you actually need the money, you're going to pay a penalty to take it out.
And Carrie, just to follow up there, what could lower rates mean for borrowers?
Yeah, that's a real sweet spot, because it can very much lower your monthly bills, right? Particularly on credit cards, right? So, what happens, it has a very direct impact. And what happens is your annual percentage rate, the yield, the rate that the credit card companies are going to charge you, they use that prime rate as a starting point to determine what your interest rate is going to be. So if it drops down, it's going to drop down. And so that APR is that. Plus, they generally go maybe 3 points above that to set the rate, and then they determine how your credit score, how that plays into it. So there's some wiggle room on what your rate will be, but you can anticipate those will dip down somewhat. It's not going to be huge, but it will drop down, but don't expect it to happen overnight. They don't react as quickly as the banks do. So your credit card interest rate, for it to dip down, it usually takes 2 billing cycles, or roughly 2 months, before it actually, you'll see that number drop down in your account. So I encourage people to keep an eye on that, because that's a very positive thing. And finally, if you have a big purchase you're looking at ahead of you, maybe it's a car, maybe it is a house. We already see mortgage rates ticking down now. You might hold off a little bit just to see if this goes through in September if you can.
All important things to keep in mind. Carrie Hannon, thank you so much.
Thanks.
Universal Music Group, which represents A-list stars like Taylor Swift, Billie Eilish, and more, announced an expanded licensing deal with Meta on Monday. The agreement will, quote, further evolve the creative and commercial opportunities for artists on the platform. It will also allow the label's music to be uploaded to WhatsApp without violating any copyright ownership. While details of the multi-year agreement have not been released, the announcement from the two companies says that issues like proper compensation, unauthorized AI-generated content, and opportunities for artist monetization are all being addressed. According to a statement from Meta's Vice President of Music and Content Business Development, the partnership, quote, builds on the recognition that music can help connect us and brings fans, artists, and songwriters closer together, not only on established platforms such as Instagram and Facebook, but also in new ways on WhatsApp and more. As part of the renewal, artists and songwriters will receive part of the ad revenue for any posts featuring their work. Much more on wealth after the break. You're watching Yahoo Finance. We'll be right back. you tired of corporate tricks and scams? Well, it might be getting a little better. Today, the Biden-Harris administration is launching a new regulatory effort titled Time is Money to protect consumers. The key actions include making it easier to cancel subscriptions and memberships, requiring airlines to issue automatic refunds if a flight is canceled or significantly delayed, and allowing health claims to be submitted online. The effort is also cracking down on customer service doom loops, which is when consumers get stuck in a menu option maze with automated recordings and ineffective chatbots. It will also streamline parent communications with schools. This seems like a lot of promises, so can it deliver, and how big will this be for everyday Americans? To discuss, Yahoo Finance's Rick Newman joins us now. And Rick, I'm curious to get your viewpoint on this Biden-Harris administration that's really cracking down on corporations, not just with this effort, but what we saw earlier this year with hidden junk fees as well.
Right. They're going big and they're going small. So Biden does some big things, infrastructure, green energy, but he's also drilling deep down into the consumer experience and a lot of things that drive people crazy. It's too bad he didn't put like spam calls and spam text messages in there, right? So this is not going to happen overnight, and so this all goes into the rulemaking process, which means it has to become part of the regulatory code. It would be enforced by agencies such as the Federal Trade Commission. And you can imagine that even once these things were on the books, let's say it gets that far, then how do you get companies to comply? I think it's a long road to actually seeing tangible improvements. But if Kamala Harris wins the presidency this year, I guess you would expect to see a continuation of this policy or the set of policies, and then maybe by this time next year they might be fully in effect with some enforcement behind them. There's clearly a political campaign element to this. Probably no accident that it's rolling out just as Kamala Harris is trying to convince voters in swing states and they're literally going after every last vote. So if she can say, look, Joe Biden started this and I'm going to continue. We want to make your life as a consumer a little bit easier. It certainly can't hurt. We'll see if it actually gets anywhere, though, in terms of making our consumer experience better.
And Rick, I should mention that you can actually share feedback in a portal about what they should tackle next. So maybe the scam phone calls and text messages. Maybe that's something that we could work on together with this administration. But stick with us, Rick, because I want to switch gears to the 2024 presidential election. A new poll by the New York Times and Siena College shows Vice President Kamala Harris leading former President Donald Trump by 4 percentage points in 3 swing states: Wisconsin, Pennsylvania, and Michigan. As we get closer to the election, we want to address the biggest differences between the 2 presidential hopefuls. And today, we're tackling their tax policies. Steve Rosenthal joins us now. Steve is a senior fellow at Urban Brookings Tax Policy Center. And still with me is Yahoo Finance's senior columnist, Rick Newman. Steve, there's still a lot we don't know about Harris and her plan, particularly when it comes to tariffs. We do know that Trump wants to hit China with a 60% tariff. Biden also had some aggressive tariff ambitions. But from what we do know so far, what are the biggest differences in the tax plans of these 2 candidates?
Well, we can both look backwards and forwards. Backwards, Trump and Harris disagree about the Trump tax reform of 2017. Much of it is set to expire 2025, and Trump wants to extend it. Harris in the past has suggested repealing all of it. And that tax cut package had very large cuts for corporations and for high-income individuals. And there's a face-off there. Going forward, we know relatively little about Vice President Harris's plans. But as Rick just suggested, with respect to the corporate initiative, we would expect Harris to continue a lot of the Biden-Harris proposals, which involve a lot of taxing the wealthy and high-income individuals.
Hey, Steve, we have now heard Kamala Harris come out in favor of a Donald Trump idea, which is that there should be no income tax on tips. So 2 questions on that. Congress would have to pass a law that making that change. Is there any chance that Congress would ever pass a law like that? And how much of this is just politics trying to play to people who earn a lot of tips in swing states like Nevada?
Well, Rick, surprise to say, but politics plays a big role during a campaign. And we're in a silly season with tax policies being proposed that, in my view, make very little sense. Now, could Congress enact this exemption from tips? It's possible. I used to work for Congress helping to draft tax rules, and it's really hard to draft a sensible tax rule to exempt tips. How do you separate tips from wages? And how do you stop a whole bunch of other employees asking to be compensated in tips? And so could Congress do it? Maybe. The price tag could be something like $200 billion. And then the cost for the rest of us is to make up both that $200 billion. And then do we really want more employees requesting tips rather than wages, like our grocery tellers, our plumbers, all sorts of service sector employees might start asking for tips. And frankly, I've been getting sort of tired of being asked for tips every time I buy anything. And so, I think this idea has a lot of problems to it. It may yet go forward because there's interest expressed by both presidential candidates, but there are a lot of problems to work through.
And Steve, you mentioned the Trump tax cuts. They expire in 2025. As you said, President Trump will likely extend them if he were to win the election in November, where Harris would likely repeal them. What would that mean for everyday Americans if the current cuts are repealed?
Well, if the current cuts are repealed, certainly for high-income taxpayers, they would face higher income tax rates. For other taxpayers, middle-income taxpayers, they would see the standard deduction. I think that'd be the largest item. Their standard deduction lowered. It was doubled in 2017. However, from the tax standpoint of high income versus low income, I think high income taxpayers would see a lot more of a hit than low income taxpayers and middle class taxpayers.
Steve, what do you view as the likelihood that we could see some kind of tax package that would repeal the cap on state and local taxes, which a lot of Democrats want to do?
Well, Rick, that state and local tax cap is set for expiration in 2025. And so if Congress ends up not doing anything and all the individual items, both the tax cuts and the tax increases expire, well, then it could go away. Now, if in fact the tax cuts and increases, the individual items of the 2017 tax reform measure are extended, well, there'll be an argument over the SALT deduction. And I think there's both Republicans and Democrats who'd like to see the cap, if not increased, completely eliminated. We'll see. I think it's touch and go.
Steve Rosenthal, Senior Fellow at Urban Brookings Tax Policy Center. Thank you so much for joining us. And thanks to our very own Rick Newman as well.
Yeah.
Bitcoin is up more than 35% year to date, and with big gains comes big tax responsibilities. To discuss best tax strategies for your Bitcoin investments, we have Andrew Gordon Law Partner, tax attorney, and CPA. Andrew, thank you so much for joining us. Crypto, it can be confusing enough to new investors, let alone the tax element of things. But on a most basic level, how should investors approach paying taxes on crypto?
Sure. So although cryptocurrency can be considered very complex from a tax standpoint, at the most basic level, it's taxed much the same as stocks or other securities. And so there are long-term and short-term capital gains, and you're taxed every time there's an exchange, a swap, or a sale. But what makes crypto unique is that you're not just taxed when you cash out to cash, but you're also taxed every time you convert from one crypto to another.
And Andrew, we've seen crypto creep more into the political conversation. We had former President Donald Trump speaking at the Bitcoin conference in Nashville recently. What do you make of just the fact that crypto is becoming more part of the political discourse? Is this a good thing for the asset down the line?
So I've been in the crypto industry for at least the last 10 years, and I have never seen politicians embrace crypto and Bitcoin specifically as they are today. I was recently at the Bitcoin conference where there was not one, not two, but there were 3 presidential candidates, including one former candidate speaking on behalf of cryptocurrency, talking about regulation they want to implement to increase the adoption and use of crypto. President Trump spoke specifically about how during his time as president, the price of Bitcoin increased significantly. So overall, I would say that this is a good thing. It seems to mark a shift from regulation by enforcement, which we have seen for several years through agencies such as the SEC, but perhaps now a shift to politicians supporting and embracing crypto and implementing regulation and legislation to support, to allow innovation to occur, and to allow individuals to hold crypto and not become criminals.
So, Andrew, what ramifications do you think a Trump administration or a Harris administration would have on crypto, and in particular, the tax policies that surround it?
So we have seen so far mostly the Republican side embrace cryptocurrency. And what I hope will happen over time is that it becomes an issue that regardless of which side of the political front you're on, that you understand that the crypto tax side of things needs to change. With over 40% of Americans holding cryptocurrency, it's time that the tax gap be reduced by policies that allow individual investors to report crypto simply, easily, and also allow the IRS, the Treasury, to collect on taxes that are rightfully owed. What I hope is that there are new policies, such as safeguards, and I've outlined several of these policies on cryptotaxreform.com. But for instance, under current law, the wash sale rule does not apply to crypto. But over the years, we have seen legislation, we've seen attempts to hamstring crypto investors by making the wash sale rule apply to crypto. Hopefully, with this new shift, this new embrace of crypto in the political landscape, there will be less of this legislation that impacts taxpayers negatively, but instead puts in place laws and rules that allows investors to report without the cumbersome regulations that have been in place to date.
Andrew Gordon, Gordon Law Partner, tax attorney, and CPA, thank you so much for being here.
Thank you.
Much more on wealth after the break. You're watching Yahoo Finance.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Nearly half of Americans consider themselves broke, and take-home pay can contribute to that feeling. But what might be more important is what you're spending that money on. Zero balance budgeting assigns a job to each and every single dollar of your take-home pay, so you can take control of your wealth. Here to discuss how to implement this budgeting strategy to your everyday life is Scott Ward, Compound Planning SVP and Wealth Advisor. Thanks so much for being here. How does zero budgeting compare to other strategies out there? And why is this a viable choice for consumers and Americans looking to get closer to their financial goals?
Yeah, so first of all, thanks for having me, Alexandra. I think it's important to step back and say, what's my motivation for establishing a budget in the first place? And what happens if I don't? And so zero-based budgeting does have a way of helping individuals assign in advance where every dollar will go toward their monthly expenses. And the importance behind this is that more than 2/3 of Americans, 68%, are worried that if their circumstances should change, like they lost their job, they would be unable to meet their monthly expenses beyond just 1 month. The other aspect that I think is important to keep in mind is that more than 6 in 10 Americans have less than $250,000 set aside for retirement. And so taking control of your cash flow allows you to not only address your short-term goals, but it also allows you to think about more strategically the things you'd like to accomplish in the long run, like being able to retire on time.
Mm-hmm. And how should this differ depending on your age? Because your financial goals when you're older or perhaps in retirement, they're likely very different from someone who's just starting off on their first job.
Correct. Well, I think the important thing, regardless of the age, is really to take inventory of all of your expenses. Apps have a way of helping with that. YNAB is one. My own firm, Compound Planning, offers a dashboard. There's a plug for you to allow individuals at all ages to get a handle as to where their money is going each month.
But how do you sift through the noise of that? Because like you were just saying, there's a lot of financial planning apps. There's also a lot of financial influencers out there on social media, and there can at times be misinformation out there. So how do you find the resources that can help you make the best decisions that are specifically tailored to your financial goals?
Well, I think first of all, you've got to have a clear understanding as to what your fixed expenses are each month, and where your sources of income are coming from each month, and taking a very deep dive in terms of where the money ends up, who's getting paid, how much, and why does that matter. And I'll mention one real life example. Even in my own home, it's very easy to link apps that automatically renew a subscription or some kind of expense. And I think having to go through the pain of actually making a decision to automatically renew a subscription or to make some kind of app purchase can free up some extra cash flow at the end of the month.
And what is the biggest budgeting mistake that you see people make when they're starting this process?
I'd probably say the biggest mistake is just not having, is getting into debt. That exceeds your monthly cash flow in terms of being able to handle that debt. That's one. I would say the other is really not keeping track of where your money is going each month.
Scott Ward, Compound Planning SVP and Wealth Advisor, thank you so much for joining us.
Thank you.
Coming up, while end-of-life planning is never a fun conversation, it can be necessary. We have some helpful tips when we come back.
Originally inspired by General Motors ending its EV1 program, Tesla has become the world's leading electric vehicle manufacturer. In 2023, Tesla generated nearly $97 billion in revenue, and its market cap is over $570 billion. The company was Yahoo Finance's top trending ticker of 2023, with over 300 million page views. Let's take a look at some of the company's biggest moments with Beyond the Ticker. Originally named Tesla Motors, Tesla was founded in 2003 by Martin Eberhard and Mark Tarpenning. Elon Musk joined the company in 2004, investing over $6 million of his own money and becoming chairman of the board. In 2006, Tesla unveiled the prototype for its Roadster, which entered production in 2008. It was the first all-electric car to use lithium-ion battery cells. After co-founders Eberhard and Tarpenning left the company, Musk took over as CEO in 2007. On June 29, 2010, it went public via IPO on the Nasdaq at $17 per share. In 2016, Tesla unveiled the Model 3, its first mass-market vehicle. Later that year, Tesla agreed to acquire SolarCity for $2.6 billion. On July 6, 2017, Tesla's stock crashed after delivery concerns. The company lost more than $12 billion. Defying expectations, Tesla recorded 4 profitable quarters in a row from 2019 to 2020, making it eligible for inclusion in the S&P 500. On November 4, 2021, the company reached an all-time high stock price of $409.97. Originally introduced in 2019, the first Tesla Cybertrucks were delivered to customers in November 2023. Tesla continues to produce despite its setbacks due to lawsuits, manufacturing delays, and Musk's controversial statements. Investors will continue to wait for the next wave of innovation from the world's most valuable automaker.
The conversation around end-of-life planning can be a difficult one to have, but it's also necessary. Here to help with some tips on how to make sure you and your loved ones are financially prepared for the future is Greg George, Crescent Grove Advisors Managing Director and Senior Client Advisor. Greg, like we said, this is a difficult topic, but it's also an important one. At what age and under what circumstances should someone begin this process?
First off, thanks for having me. It's a pleasure being here. I do believe probably in their early 30s, when one's starting a family of their own, maybe the prospect of marriage or children on the horizon, I really do think one needs to plan for, the event, if you will. While still young, and presumably with a long life expectancy, things happen, and unfortunately bad things can happen. So to have things lined up the way one would wish, have it documented appropriately, and be very organized in the process will simply make things a little bit easier on the back end for those who survive you.
And Greg, is there a first step of sorts that people should make when beginning this type of planning, or even just preparing for this type of planning?
Yes, I think taking an inventory of where you currently stand, economically, financially speaking, certainly turn to your company's plans and their benefits. A lot of wealth is embedded in those. But of equal importance, sitting down and thinking, when I'm no longer here, what do I want this to look like? Because there are vehicles that exist that allow one to, for lack of a better term, rule from the grave, not in a heavy-handed sense, but more in a sense of these are assets that you've built over time, you've worked to accumulate, and you have the right to dictate how things play out once you've passed away.
And what if you're a family member wanting to help here? Is there something you should be doing differently than the individual?
From the standpoint of looking at things, I think it's important to sit down and determine who's on the team. And the team is broad. It needs to consist of not only financial professionals like myself who have an overarching view of one's particular situation, but a professional in the estate planning field. And then pull in those people who've been along with you for the journey, whether it's a brother, a sister, a college friend who's remained a lifelong friend, and pull that team together and get everyone on the same page as to, hey, look, here's where we are at a snapshot in time. Here's what we're trying to achieve. I appreciate everyone's willingness to help in this process, and let's get an end result. And to use the term end result isn't exactly accurate, because this is a process. What you're thinking about when you're 45 is much different than what you're thinking about when you're 55, 65, et cetera. And the other thing you have the benefit of is time. You've seen those children who maybe when you executed your first set of plans, they were 5 and 6 years old, and now they're 15 and 16 and so on. So while the plans are good until changed, I think it's important to periodically revisit them with the team.
And another topic that we often discuss on this show is the great wealth transfer. If you're young and you come into money, are there certain steps that you should be taking in order to protect some of those assets?
Yes, absolutely. Depending upon how you come into that money, certainly if it's clearly from inheritance or another means, you want to sit there and ask yourself, first and foremost, am I taken care of during what I expect to be a full life expectancy? Once you answer that question in the affirmative, you get back to, okay, what would I like to achieve with this money? What are my goals? And you walk through that process and you determine who you want to benefit from this. It's not a windfall because oftentimes it's earned, but who you want to benefit long-term from this. And along those lines, you can certainly have people benefit at your passing, or there's always meaningful leverage associated with gifting while you're still alive. And one of the ancillary benefits of doing that is you as an individual get to sit there and witness the impact that it's having on those who have received the generous gift that you may have made.
Greg George, Crescent Grove Advisors, Managing Director and Senior Client Advisor. Thanks for being here.
Thank you. Take care.
The job market is tough. We're speaking to one career expert on how you can land your dream job in this market. That's right after the break. The job market is tough, but there are some ways that you can make your profile stand out from the crowd. Here to discuss what you need to know if you're in the market is Jasmine Escarella, my perfect resume career expert. Jasmine, thank you so much for being here. Like we were just saying, we're in this very wonky jobs market. So let's say you do want to leave your company or your position, but you feel trapped right now. What should be some of the first steps that you take?
Yeah, so the first step to really take is to understand your unique skills, the value that you bring to an organization, and really to then ask yourself, who in my network can I be talking to or discussing my unique value, what I'm looking for next, to help me facilitate making connections towards potential jobs. One of the great things that job seekers have right now is the unique asset of LinkedIn, where if you know your value, your contribution, your stories, you can share that very openly with the professional field, and you can really be making connections that we couldn't be making in the past. So job seekers who especially find themselves in a competitive market or in a competitive industry can be utilizing their network, but also these digital tools and these digital assets to showcase their brand in a very unique way and stand out amongst the crowd.
And what are some problem areas that you often see with resumes and applications that folks should keep in mind and hopefully avoid in the future?
Yeah, I love that we have created very tech-savvy job seekers who know everything and anything about the ATS. So we all know that it's so important that you showcase your keywords, your skills, your experience, and that really comes from the job position, the job posting. But what you also want to be able to do is to show not just your experience, but that you can get results. So when you're thinking about your application materials, especially when it comes to your resume, you want to make sure that it's very results driven as well. So you want to have quantifiable achievements if possible, but if you don't, you can use something that's more anecdotal, but paint a good picture that I can't just not do the job, but I can get the results for the job as well.
And artificial intelligence, that's been a big topic of conversation, especially for workers. What's your advice when it comes to using AI to help craft a resume or craft a cover letter?
Such a great question. What I say is, this is a very competitive market, so use things to your advantage. But when it comes to AI, use it wisely. It's wonderful to help you provide a foundation or a base. But what you want to understand is that people are still hiring humans. And so you have to put that human element into all of your branding materials. You also want to understand that you are the one who can uniquely position yourself for the role. You know what your skill set and experiences are. So AI doesn't know that. So you want to use it as a foundation or a base, and then you layer onto it. And for things like your cover letter, which is a supplement to your resume, you want to be more personality driven. You want to talk about your why, your story, why this company aligns with your mission, your core values. You want to explain things like career gaps or career transitions. And AI just isn't going to be able to grasp that in the same way as you can.
Now, if your cover letter is optional, is that something you should still do? And how do you know if people are actually reading these things? Because cover letters, they take a lot of time to really craft.
Yeah, everybody always asks me that question. I think cover letters are those things that everyone is hoping goes away soon, but I love them. I really do. When you think about a resume is really a laundry list of all your greatness, of course, but your cover letter is that personal touch. And when you think about your resume, there could be gaps on your resume. There could be a story there that you're missing in telling. And that's when a cover letter is so important, to tell a story, so that when a hiring manager is looking at your resume, if they're wondering, why this shift? Why this transition? Why this gap? Why this company? You're addressing that in that supplemental material, in that cover letter.
Jasmine Escarella, my perfect resume career expert, thank you so much for being here.
Thank you so much for having me.
Well, let's do a final check of the markets here. We're seeing stocks mixed across the board. The Dow is off about 0.2%. The benchmark S&P 500 is up about 0.3%. And then we have the Nasdaq Composite up 0.5%, or roughly 85 points there. And that's being driven by shares of Nvidia, which have risen more than 5% in early afternoon trading, leading to some of the rally that we've seen in tech. Of course, markets have been on a wild journey over the past week or so following that disappointing jobs report data, but we have more data out later this week that will likely impact the path forward here when it comes to the Federal Reserve and interest rates, along with what we could potentially see in this market. We have the producer price index out tomorrow, and then we have the consumer price index out on Wednesday. So that's something that investors will be watching closely. That's it for Wealth. I'm Alexandra Canal filling in for Brad Smith. Thank you so much for watching, and stay tuned for Market Domination with Julie Hyman and Josh Schaefer. That's coming up at 3 p.m. Eastern. You won't want to miss it.